Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Diane King-Hall in for Brad Smith today. And here are three things you need to know this morning. Fitch has downgraded the U.S. government's credit rating, and this is only the second time that has ever happened. The first was back in 2011. That's when fellow credit rating agency S&P cut the rating to the same level. That's AA+. Fitch said its move reflects a, quote, erosion of governance, which has manifested in repeated debt limit standoffs. This hour, we speak with a series of top voices on the move, including Allianz's chief economic advisor, Mohamed El-Erian. Former President Donald Trump has been indicted over his role in attempting to overturn the results of the 2020 election. The indictment includes 4 criminal counts, including conspiracy to defraud the U.S. This is Trump's third indictment this year, and taken together, the 4 charges laid against him in the 2020 election case carry a maximum sentence of 55 years in prison. And CBS beats the street on the top and bottom lines amid a cost-cutting program that will see it shed 5,000 jobs. The healthcare business reporting net income of $1.9 billion for the second quarter. That is a 37% decline from the same period in 2022. CBS also holding firm on its full-year adjusted earnings guidance of $8.50 to $8.70 a share.
Let's get right to that top news. Fitch has indeed downgraded the U.S. government's credit rating. Now, this is only the second time it's ever happened. The first was in 2011. It was historic then, when fellow credit rating agency S&P cut the rating to the same level, AA+. Julie Hyman is over at The Touch to break this down for us. And I remember at the time that it was very surprising, Julie. You had this major move, and now this too surprising.
Yeah, surprising in a very different way this time around. So just take a step back and put this in context here. There are 3 major credit rating agencies in the U.S. There is Fitch, which made this most recent downgrade. There is S&P, and there is Moody's. Now, it was back in 2011 that S&P downgraded the rating of the U.S. to AA+. That's where they remain today. Fitch just making its downgrade. Moody's remaining at AAA for U.S. government debt. And in terms of why Fitch is doing this at this time, they came out with this and talked about that it reflects expected deterioration here, a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters. Basically, this hearkening to the continuing and persistent battles over the debt ceiling, for example, and other fiscal matters. Even though this battle has been resolved a couple of months ago, Fitch deciding to pull the trigger and make this decision now. Now, if you look at what happened in markets back in 2011 at this time, you've got the S&P here in purple, you've got 10-year yields here in blue. We were coming sort of out of the aftermath of the financial crisis at this time. There were debt crises all over the world and concerns about ballooning debt in Europe in particular at that time. And there, again, was a debt ceiling standoff. It was really a shock when S&P at that time made that downgrade. And that shock is reflected in the drop that we saw in the S&P 500. It ended up dropping a little more than 19% from its highs to its lows. What happened on the yield side, though, was rather curious, because rather than causing selling in the Treasury market at that time, it actually caused buying in the Treasury market and kept a lid on yields. That was because people were looking for safety in what felt like an uncertain environment. And even with the downgrade, Treasuries were still seen as a safe place to be. So it was really kind of an interesting reaction. Something similar kind of happening today, but we'll talk more about that. And then what's interesting this time around are some of the reactions that we are getting as well. Oh, excuse me. Got to remember this as well, putting this in context. The amount of overall marketable Treasury debt has ballooned over this period of time. Even since 2011, we've seen it climb, and it's above $20 trillion. So there is also some talk that a downgrade at this point might have less of an impact just because of the sheer size of the Treasury market and how many different entities hold that Treasury debt. Now, to get to that reaction that we've gotten from several notable figures to this most recent decline, most recent debt rating downgrade that we've had. Treasury Secretary Janet Yellen putting out a statement, for example, calling this move by Fitch arbitrary. She strongly disagrees, she says, with Fitch Ratings' decision. So that's interesting. Former Treasury Secretary Larry Summers called this bizarre and inept. And then Mohammed El-Arian, who's president of Queen's College, Cambridge, and also a senior economic advisor to Allianz, said he is very puzzled by this move by Fitch. So whereas the reaction was quite different back in 2011, it's interesting that a lot of head scratching going on at this move.
Those are the words, those are the exact words I was going to use. This has been a head scratcher to a lot of people, unexpected kind of turn of events, though Fitch had indicating this may be coming down the pipe. Fitch certainly catching investors off guard. Now, this, despite the rating agency warning over the last few months, it could make this kind of move. So let's talk about market reaction. Joining us now, Michael Arone, State Street Global Advisors Chief Investment Strategist for the U.S. Spider business. Okay, Michael, so it did seem like a surprise yesterday when the announcement came out. What would you say was the most surprising piece of this? Was it the news itself?
I think what happened is in May, Fitch did put the U.S. on watch. Mm-hmm. So I think we need to take a step back in terms of the surprise element of this and recognize that they were evaluating. And to me, I think the biggest thing is around those governance standards. And I think what they're basically acknowledging is before the ink was even dry on the debt ceiling resolution, a small faction of Republicans were already questioning the deal and threatening to hold up some of the budget requirements for later this year. And you add in the additional spending from kind of the rescue plan, the American Rescue Plan, the Inflation Reduction Act, the infrastructure bill, combined kind of with lower tax receipts and higher interest costs. And I'm not all that surprised. I think the biggest thing is that the market hasn't really reacted all that much to this so far.
Why not?
Well, I think times are a little bit different in terms of we were coming out of the financial crisis. Years of excess had built up in terms of the mortgage crisis that had to be worked through. You mentioned Europe, Julie, for example, was also undergoing their own debt crisis. And I think it was just a much greater volatile time coming out of that, kind of the aftermath of the global financial crisis. Today, I think the economy's growing, earnings seem to be bottoming, the Fed perhaps is getting closer to the end of its tightening cycle. And so I think that there are just a number of conditions that are a bit better today than we were in 2011.
So we kind of had an offline conversation before the show started about like companies that this may impact. And, you know, we had a conversation like Apple, this wouldn't matter to them. Yeah. So what kind of companies does this matter to?
I think there could be an impact as you move downstream in credit quality. So below investment grade, junk bonds, loans, those types of things. If they're pricing off of 10-year Treasury yields and there's a pickup in 10-year Treasury yields to reflect kind of a less secure credit rating for the U.S., I think that's where you're going to have your biggest impact. Apple, stealth balance sheet, lots of cash on the balance sheet. They already have a better credit rating than the U.S. already. So I don't think it's going to kind of bother those bigger, top tier, high credit quality companies. I think maybe at the margins, as you move down in credit quality, you might see some impact. But I think spreads yesterday, in terms of junk bond spreads, were well behaved. The market really didn't react too much to the news.
And are there any implications for Treasury investors, for that matter, the debt itself that they downgraded?
So, Julie, I think that is one of the key things that was interesting, and you had shown some of the charts and the reaction. So last time, there was this flight to safety and yields fell, which is counterintuitive. This time, I think there's a few dynamics going on here with the Fed raising rates. Japan is now moving away from yield curve control. So they might be buying less treasuries and buying more domestic debt. So all of a sudden, you could see rates creep up here, which is different than last time. And I do think that'll have a broader impact on the markets because I think that'll hurt valuations. Now, we haven't seen it yet, but this is worth watching. So if 10-year Treasury yields creep up instead of down, that has impacts for risk assets.
Do you think this does anything to kind of how the dollar stands as the reserve currency, its status there, or is this a nothing burger?
So that's why I don't know, like, you know, Larry Summers and some of the reaction. Boy, I wouldn't shrug this off. The reason that the U.S. has been able to kind of withstand so many economic challenges is the exorbitant privilege that we have as the U.S. dollar being the world's reserve currency. Kind of playing with fire with that. Boy, I think that's risky. Now, certainly that's not going to change overnight, but boy, I wouldn't kind of diminish the potential risk of basically challenging the US dollar as the world's reserve currency. And this whole idea on governance standards and the fighting and the debt ceiling, they're playing with fire. Now, again, I'm not Chicken Little here. The sky's not falling, but I do think that that is a risk to markets. It really is the key reason the U.S. has been able to withstand so many challenges over the years compared to other regions of the world, compared to other countries. And to challenge it or to put it at risk just seems silly, especially because I don't think it's necessary.
Michael, stick around because I want to segue into our next topic, which sort of is related to what we're talking about that sort of dissent, if you will, within the U.S. government and inability to get some of this stuff done. And it has to do with former President Donald Trump, who has now been indicted over his role in attempting to overturn the results of the 2020 election. The indictment, which was filed Tuesday, includes 4 criminal counts. The first, conspiracy to defraud the U.S. The second and third charges revolve around obstruction of the procedural vote count at the Capitol on January 6th. And the final charge is related to conspiracy over Trump's efforts to overturn results in states with close vote counts. Remember, this is Trump's 3rd indictment this year. In March, he was indicted in connection to a hush money scheme involving payments to adult film actress Stormy Daniels. In June, he was indicted in connection to his handling of classified documents. And taken together, the 4 charges laid out against Trump in the 2020 election case, the one that was just filed, carry a maximum potential sentence of 55 years in prison. Let's bring in Yahoo Finance's Rick Newman to talk about all of this. Now, Rick, I just laid out the other indictments, right? This, though, is the one, right? This is the one that really gets to the heart of democracy, if you will, and his potential challenges to it.
Yeah, I guess you could say that, although legal analysts say that the last set of charges in the documents case is actually a little bit more straightforward than this one. But the documents case, let's remember, that is filed in Florida. So when that goes to trial, it will be a jury of Floridians from Trump's home state. This one is in the District of Columbia, where Trump, in theory, would probably have a less friendly jury. So the charges are spread all around. And I don't know if Trump were to get elected president in 2024, maybe Fitch would downgrade the U.S. credit rating again. But it's just a head-spinning series of events here. And Donald Trump is actually polling higher among Republicans by about 10 percentage points than he was before any of these charges were filed. So these charges are actually making Trump more popular among Republicans, and they are a fundraising boon for him. Every time he gets charged with crimes, his fundraising spikes. So this is just a phenomenal development in American politics, and it's going to be fascinating to see how this actually plays out.
Speaking of how it plays out, Rick, remind us, what are the implications if he is elected, again, with these criminal charges hanging over him?
The biggest question, I think, for the 2024 election is whether any of these cases will actually go to trial and be complete by the time 2 things happen. One is by the time the Republican primaries are over, and the second is obviously by the time of the general election. So the New York City case that trial is scheduled for next spring. The Florida documents case, that trial is scheduled for next May, and we don't know yet when this third set of charges will go to trial. But legal analysts are saying that it's a streamlined set of charges. So the prosecutor, Jack Smith, could have brought other charges against Trump, but they would have been a little more complicated, and they might have led to more delays. So this third set of charges does seem designed to get to trial quickly. Now, these trial dates could slip. Trump doesn't want any of these trials to happen until after the 2024 election. And of course, the Justice Department wants to get these over and done with before the election. So that is the biggest thing to watch for. I mean, it is very possible that Trump is going to be a convicted felon facing jail time by the time of the 2024 election. So puzzle that one out. That's never happened. Nothing like that has ever happened before.
What a way to finish a report. Rick Newman, thank you for your insight and more.
Bye, guys.
Thank you, Rick. All right, still with us, Michael Rohn, State Street Global Advisors Chief Investment Strategist for the U.S. Spider business. We want to get your reaction, Michael, to this development. And Rick just made the point about, like, this is uncharted territory. How should the market be looking at this?
I think the market will mostly ignore this, Diane, until the election gets closer, until we get more clarity about when these trials will take place. What will the resolution be? Until then, they're going to focus on the Fed. They're going to focus on earnings and kind of how the economy's doing. Until we get more clarity in terms of the implications of the outcome here, I think the market will mostly ignore a lot of the politics. It's fascinating, right? The top two stories that you had this morning, the market's mostly shrugged both of them off, the downgrade and the Trump indictments.
But should they? And I don't mean the indictment specifically. The indictment seems to be a symptom of the same thing that the downgrade is a symptom of, which is this deep division within America, both culturally and politically. And, the market, we always say the market's a discounting mechanism 6 to 12 months out, but it's not a very deep, long-term thinker, if you will, right? Yeah. But is it sort of ignoring these divisions at its peril? Is there a way that investors should be thinking about this?
I think the biggest implication is, will these items, will the indictments, will the downgrade lead to higher interest rates? What is the peripheral effect, right? So the classic, the butterfly flaps its wings here and something else happens kind of miles away or tens of thousands miles away. So to me, the biggest risk is, how does this impact? Does the borrowing costs of the U.S. increase as a result of Trump being indicted, Trump being elected, the downgrade in terms of from Fitch for those types of things? That's when the market will wake up and take notice. Until then, they can largely shrug it off. They don't have to deal with it. They're more focused on the earnings. And again, I'm not trying to push us towards there, but I know we're going to talk earnings.
That is the perfect segue. We're going to talk about that right now. It says if you wrote it yourself.
Yeah.
So as you mentioned, earnings season
I want to get away from the credit rating. I want to get away from Trump indictments. Let's talk earnings.
Let's do it. Let's do
Great
it.
pivot.
That's what investors are watching right now. Earnings season is indeed in full swing, with over half of the companies on the S&P 500 having reported results so far. 80% have seen earnings beats. That's according to FactSet. And Michael Rohn is still with us, State Street Global Advisors, U.S. Spider Business Chief Investment Strategist. Mike, you mentioned earlier you think that earnings are sort of bottoming here, or earnings growth, or in this case, declines, are as bad as they're going to get. Walk us through that.
So potentially, I do think this could be the bottom in the earnings cycle. So the fourth quarter, first quarter, and second quarter are all difficult. We've had sequential earnings per share growth that's been negative, and we're forecasted over the next couple quarters to be positive. Some positive signs, and ones I know that we'll chat about, is around technology. They had 5 consecutive quarters of very disappointing earnings, and now technology companies are going to grow their earnings year over year by more than 9%. So we know that they make up such a big portion of the indexes. That's going to be a positive contributor. And for all of the anxiety around financials, they continue to surprise on the upside. So financials are going to grow their earnings year over year by more than 8%. Now, I agree with most market observers that those earnings are likely to come under pressure due to regulatory response to the challenges in the March-April timeframe, due to the fact that they're going to have to increase interest on demand deposits and the like. But overall, financials and technology, 2 huge sectors of the market, are growing at 8 and 9% earnings. And that's not just that. For technology, the next several quarters are supposed to gain momentum and do even better. And that's going to be a key contributor for the market. They've already had 5 bad quarters. We're looking forward, and they're actually going to do quite well, it looks like.
So the focus is forward, especially one company that we've been watching is AMD. They put out their results. They got an upgrade off the back of it. Citi upgraded AMD after its earnings. Revenue did decline, but it's kind of shrugging off any kind of backwards thinking. Earnings beat, but again, it was that kind of low bar thing, especially when you compare it. I mean, they ate 58 cents a share, beat by a penny. Down from last year in terms of earnings, but again, it's that forward thinking. Is it in the tech sector? Is the focus just all about AI?
I think AI is a big component of it, and I certainly do think that as you look at AMD, part of their announcement today was an AI component, that they're going to make an AI chip for China that meets all of the regulatory requirements and things. And so the stock could be getting a little bit of a bump due to that. AI is going to be in this phase where it's a bit of everyone's going to get a premium. Everyone's talking about it. Campbell Soup's talking about AI. So it's going to get some bump as a result of that. And I think that the winners and losers will be more determined kind of in the next 18 months or so from that standpoint. I think the key here is that expectations for earnings got to such a low point. Everybody was expecting recession in the first half of the year, and it hasn't materialized. And as a result, all of these companies are easily surpassing very low expectations. And that's what I think is kind of really spurring the rally for the markets.
Mike, you sound pretty bullish.
I am. It's interesting, Julie. I've had this opinion since last August, and I was a little early. And it's this notion that the markets are not the economy and vice versa. So I do expect that as a result of all the rate hikes, that the economy will slow. Earnings will continue to be sluggish for a little bit, but I think we're hitting the bottom. And ultimately, that will find its way into the consumer and perhaps the labor market. And we're starting to see maybe the rate of growth in the labor market begin to slow. All that says, as that process unfolds, as we're chatting about, investors will look 9 to 12 months ahead. And I think they'll, excuse me, I think they'll price in what will be a recovery from that perspective. I think one of the things that's kind of really interesting here is that the Fed, in some ways, has engineered a soft landing. The economy's growing, inflation has fallen dramatically, the labor market's really strong, earnings are bottoming, the stock market's up, housing's recovery. I'm just more fearful that they're not going to accept that victory. They're going to snatch defeat from the jaws of victory and keep going. I think that's the biggest risk to the market.
Meaning in September, the potential for what happens in September. And to your point, I believe it was B of A who dropped their call for, I have to double check that.
Yeah,
recession.
it was Bank of America. They're not expecting a recession any longer.
So the more people that drop this call, the more nervous that I get. So everyone was expecting a recession in the first half, and now they're bailing on that. And similarly, when Julie and I were chatting earlier around this notion of complacency, the bears are throwing in the towel. The FOMO is coming, the fear of missing out. When this starts to happen, I tend to get a little bit more nervous in a seasonally weak period of time for markets. So it wouldn't surprise me if we have a bit of a correction in the August, September, October timeframe. But net, I have some really good news, and I'll be quick with this one, is that when the S&P is up 10% or more at this time of year, kind of in the halfway point or a little bit longer, there's only been 3 times where it hasn't accelerated that momentum. Now, those times have been really bad, so hopefully it's not. So 1987, 1929, that was really bad too, and World War II. So typically, if we're up this much at this point of the year, markets kind of build on that momentum into year end. So you're saying, am I bullish? Yeah, actually I am bullish, and I think that this will continue for at least a little while longer. The Fed and the economy are the wild cards.
All right, Michael. Thank you so much. Good to see you. Michael Aroney is State Street Global Advisors, U.S. Spider Business Chief Investment Strategist. Great to see you. Thanks so much for coming in.
My pleasure. Thank you.
It's fun. Shares of Starbucks this morning are a little changed after the coffee giant reported strong international sales boosted by China's recovery. Same-store sales did come up short of analyst expectations. Rachel Ruggieri is Starbucks CFO. She's joining us now alongside Yahoo Finance's Brooke De Palma. Rachel, always good to see you here.
Hi.
Hi.
Hi. Morning.
Good morning. You've had your coffee, clearly.
A lot of it.
So, Rachel, let's talk about, in particular, what you guys are seeing in the U.S. I want to start there and with the same-store sales growth in the U.S. and what you're seeing in terms of traffic trends versus price trends, how all of that fed through during the quarter.
Sure. We would start with the fact that we had a 7% comp. And of that comp, about a point came from transactions. And we're seeing growth across the board year over year in every single day part. And so that's a good indicator of the health of our business. In addition to that, our ticket was 6%, which is elevated. But I think what's important in our ticket is there's a balanced contribution both from strategic pricing, but also from increasing customization and record food attach. And that's important because that shows a volume or a unit component to our ticket. And so when we look at that, that's what's driving the record demand that we're seeing in the U.S. business, which led to our average weekly sales being a record this quarter. You take the combination of the transactions and the ticket with overall new store growth, and we're seeing our average weekly sales the highest we've seen in the history of our company. So it speaks to the demand we're seeing, as well as the record engagement across of our customer group. And we're really encouraged by those signs. I mean, there's a lot happening in the economy, but for us, our demand remains very strong, and we're encouraged by that. And we're continuing to fuel it with the innovation that we're making in terms of our offerings, as well as the increasing digital capability we have and the convenience channels that we're growing. We saw delivery grow this quarter from 4% of sales this quarter. It was just about 2% of sales about a year ago. So we're seeing demand continuing to increase, and we think it speaks to the strength of the brand, but also the loyalty of our customers.
And Rachel, a quick follow-up on that. Last quarter, you told us that you expect price increases to return to a more normalized level of 1% to 2%. Are you still expecting that?
Yes. Yes, in the fourth quarter, we'll have fully lapped the pricing moves that we made last year. And so we've benefited this year from the annualization of those pricing moves from last year. So we'll start to see our ticket normalize from a pricing perspective. But we still believe our ticket will be elevated because we have this ability to continue to drive customization, a mix to more premium beverages, as well as increased attached. Our reinvention plan goes directly at creating the capacity in our stores to be able to serve our customers' needs around customization and attach. And that'll show up in an elevated ticket. So we're encouraged by the demand that will continue to fuel both in our stores as well as digitally.
Rachel, I listened to your earnings call yesterday, and one of the things that stood out to me was modifiers,
Yes.
like the cold foam, et cetera, and how that accounts for around $1 billion in revenue annually. How much more can you all squeeze out of that before consumers say, uncle?
Yeah, I think it really comes down to creating the capacity in our stores to serve that demand. Our reinvention plan is positioned to be able to create a more stable environment for our partners, and that's through wages and through better training, and that's helped to stabilize the environment, bring the turnover down, and stabilize the environment. In addition to that, we've made investments in equipment and in our processes, and that helps with overall throughput. And that throughput helps us to be able to support customers' desires to customize. We don't think that's going away, and we actually have a very deliberate way to innovate and further our customization over time. But it's important to make sure that we create the capacity so that we create a good experience for our partners in serving that with our customers. And our customers naturally customize. So the more we can innovate in that space, I think we have a lot of opportunity ahead. And when we talk about modifiers, that's the same as customization. And that leads to strength in our ticket and has a volume component which supports the demand that we're seeing.
Rachel, as we talked about before, cold foam is a big modifier that is popular in these parts, in this office.
Yes.
I was also struck to see that 75% of the beverage sales are now cold beverages. And this wasn't even in the height of summer when it's super hot.
That's right.
Is this a secular change in how people consume coffee? Is this like is this just what it is now, that people are going to drink cold coffee year round and that's it?
It's definitely skewed more towards a younger consumer. And so we have a large consumer base of millennials and Gen Z, and their taste and preferences tend to be more cold. Now, I'm way over Gen Z, and I love cold espresso. But it is definitely an increasing trend, and we don't see it going away. What we are encouraged about in the quarter is that our beverage grew 10%, and that was a combination of growth in both hot and cold. So we did see growth of about 2% weighted on that 10 from a hot perspective, but we also saw cold grow about 8%. So we continue to innovate in both areas so that we can, offer coffee and continue to lead in coffee for all of the different customer tastes and profiles, but definitely cold is a big opportunity for us, which is why you see us continuing to innovate in areas like ice shake and espresso and refreshment, and even with our new blended lemonade refreshers. Those are all areas for us to be able to continue that growth in cold, which not only grows in the morning, but actually has a position across all day parts. So we see a lot of opportunity ahead, but it's definitely not going away.
And one investment that got a lot of buzz this past quarter among consumers is those new ice nuggets that you guys are switching over to. How much money do you expect to save at the end of the day with this investment? And what's the response so far?
Well, what I'd say is we're in the early journey of what we call our nugget ice, and being able to put nugget ice in our stores. We've hit our highest volume cold stores so that we can actually support the capacity. And that's largely what the nugget ice is about. It's to be able to support the capacity of the cold demand. And so we'll continue to roll out across our stores. Early on, what we're seeing is it's better for partners. It's easier in terms of overall, it blends faster. Well, eventually it'll be piped into the stores, so they'll no longer have to be, carrying buckets of ice. And so it's a better option for the partners and creates a better experience. But at the same time, our customers love it. And so the combination of that, gives us confidence that we'll be able to continue to fuel the growth, cold growth that we see, with improvements and advancements like nugget ice.
And hitting on those employees on the back end really quick, you did see baristas leaving improved by 11%. You saw take-home pay jump 20% year over year. But Lax did hint on some further improvements for baristas, for employees, you guys making month over month. Any sort of insight you could provide there? And also, can you provide an update on where you stand right now with bargaining with those unionized stores?
Yeah, I'll start with the fact that from a bargaining standpoint, what I would just start with is, from a unionization standpoint, we continue to believe that a direct relationship with our partners is best from not only a culture, but the experiences that we value. But we support our partners' decisions when it comes to, determining if they want to be part of a union, and we'll continue to bargain in good faith. What we're focused on is how do we continue to leverage our reinvention to create the very best experience for all of our partners. And part of that comes from the investments we're making in our business, the investments we're making in things like nugget ice, as an example, but also the investments we're making to create a more stable environment. And more recently, what we talked about on the call was that we're trying to find the right amount of hours for our partners. That comes through advancements we're making in staffing and scheduling. And we're on a journey. We've made some progress, but we have, a journey ahead of us. But we're encouraged by the early signs that we're seeing because it's helping to reduce turnover and create a more stable environment. And that stable environment's better for partners. It creates a better experience, but it's better for customers. So we'll continue on that journey. And more specifically, what we've done is we've taken our staffing model in-house so that we continue to innovate on a more store-by-store basis. And that way, we're more targeted in the investments. I think the real opportunity for us as it comes to labor and the investments around labor is to be more targeted on a store-by-store basis. When you think about how important personalization is and customization is in our business for our customers, it's that same sort of concept for our partners. The more we can personalize the experience, and that comes through the hours they need, the benefits they need, that's where we have tremendous opportunity ahead, largely from an engagement standpoint, which we know is a key driver of the value of the Starbucks experience.
Rachel, I want to ask you about the China story and the penetration in China. So the average Chinese consumer only drinks about a dozen cups of coffee a year. I find that shocking. I mean, I drink that, and I won't say a week, but what are you all doing in terms of penetration there, especially when you need to, say, account for some slowing of sales growth in the U.S.?
Yeah. For us, what that speaks to, that 12 cups of coffee, really speaks to the demand. I mean, this is one of the largest consumer markets in the world. And so we see the demand is increasing for coffee. And so what we're focused on, even though we're in the early journey of recovery, what we're focused on is how do we differentiate ourselves? And so we continue to focus on innovation, as well as increasing our omnichannel capability. That gives customers multiple different ways to interact with us. And we're also continuing to focus on opening new stores because that allows us to continue to bring in new customers and create new occasions. And all of that's underpinned by an experience that our partners create for our customers each and every day with every single visit. We think that that's the value of the Starbucks experience that's going to help not only in the near term, but support our long-term growth ambitions in the market.
Rachel, finally, back here in the U.S., we were very focused this morning on Fitch Ratings' downgrade of U.S. debt, which is, I realize, outside your purview, but I am curious. One of the reasons that Fitch is pointing to here is the dissent that we are seeing in government, the effect that has on fiscal policy, et cetera. And I just wonder how you guys are thinking about that issue as a potential threat to economic growth going forward in the United States.
Well, it's incredibly important, which is why we've been focused on continuing to operate within a 3 times leverage ratio. So that's the guide that we keep so that we can maintain our B+ rating, but also it allows us to be able to support, I'd say, a more conservative stance in terms of our overall financial health. You know, we have a strong balance sheet. We're strong from a financial perspective, and so it's important for us to continue on the journey as we see, you know, interest rates continuing to increase, and I'd say some instability in the overall macroeconomic environment. So our financial fundamentals are in place, and I would say position us well to be able to grow in the future.
All right, Rachel Ruggieri, Starbucks CFO, alongside Yahoo Finance's Brooke DePalma. Thank you so much, Rachel, for breaking down your latest earnings for us. We appreciate you. And Brooke, of course, as well. All right, we want to check the early action on Wall Street. Opening bell rang a short while ago. This is a market check sponsored by Tasty Trade. You're looking at all 3 major indexes under pressure this morning. The Nasdaq down more than 1%. The S&P 500 down about 1%. Dow off around 0.5% as investors have an initial reaction to downgrade of the U.S. credit rating. Let's get right over to Julie at the Wi-Fi Interactive.
Yes, indeed. And I'm taking a look at some of the trending tickers here because the focus, in addition to the downgrade, which as we talked about with Michael Aroney of State Street, they're not paying as much attention to. They're paying attention to earnings. And for example, we have Advanced Micro Devices, which is down about 1% in the early going after its numbers after the close yesterday. We've got some others like Pinterest that's only down about 0.7%. So some movers here on the earnings front. But to take a bigger picture here of what we are seeing and to look at some of the sectors within the S&P 500. We've got healthcare that is trading higher. We'll get to that in a moment. Tech in the form of the XLK is down the most, 1.3%, followed by materials and consumer discretionary, which are putting pressure on the market as well. Energy is on that list too. Looking at some of the Dow movers today, and let's equal weight it here so we get an idea of what's going on. Intel is under the most pressure here this morning, as well as American Express. Interesting to see those Intel shares down 2.5% after we did hear from AMD. And then as for the Nasdaq 100 performers here, the big guys all in the red, the so-called Magnificent Seven, whatever you want to call them. Nvidia is down almost 3%, Tesla down 2%, and so is Meta. And one of the interesting things that Michael Aroney did talk about is, unlike the last time we got the debt downgrade, we could eventually see rates start to move higher as we head throughout the year, both linked to the downgrade, linked to what the Fed is doing. And that has not been good news for some of these various big tech companies this year. So let me circle on back finally to what we are seeing in the bond market here this morning, because if we were going to see some big reaction to the downgrade, it would likely be happening on that side of the equation. And we are seeing some movement here, but it's not much. It's only a 3 basis point increase in the 10-year yield right now to just over 4%. But let me look at a year-to-date real quick of where we are. You can see that it is creeping up to the highest levels that it's been in a little while here. So that could be what is putting pressure on big tech. We've got much more coming up, guys, including some movers. You're watching Yahoo Finance.
How would you describe the state of the consumer right now?
Yeah, you know, we'd say the consumer is resilient. That is really the best word to describe the U.S. consumer through, you know, what has been a considerable number of challenges. You know, we've had higher inflation, we've had higher interest rates, we've had global economies that have shown signs of softening, but the U.S. consumer continues to power through. And in fact, what we saw in the first 2 quarters in U.S. GDP, personal consumption did go from about 4% in Q1 to about 1.6% in Q2. So we are seeing a bit of softening, but still at healthy levels of growth and consumption. We'd say the services demand is the key there. We are still seeing a lot of appetite for areas like travel, leisure, hospitality. Think about all the vacation planning we're doing this summer. The goods side of the equation, consumption and demand for goods, has softened. And so we think that story has played out over the first half of this year. We may see services demand soften over time, and that could be what we call part of our rolling downturn or rolling recessionary environment. But for now, consumer is holding up well.
Got some movers for you now, and let's start with CVS. Those shares are up about 1.6% after the company posted an earnings beat in the wake of its call to cut 5,000 jobs. That's part of a bigger effort to trim costs. The healthcare giant held its guidance steady after previously lowering expectations last quarter. It wasn't all good, though, and that's perhaps why the shares are not up more. We did see operating income in its Aetna business down 20%, and its medical benefit ratio was worse than estimated. So that might be one of the things that's holding the shares back.
Right. But it's still seeing a little bit of a gain when you see the overall market down today. So that's certainly to CVS's benefit. And I mean, we know that they talked about the cost cuts, the job cuts that they're doing. So that certainly helped give some buoyancy to shares. And on the plus side, the sales of its health services segment, that's its, pharmacy benefit business, that rose more than 7%. So that was certainly helpful to CVS Health. And we know that it's been expanding. And so some of that puts some pressure on its bottom line.
Yeah, exactly. It's getting more into patient care, direct patient care, bought a primary care company, Oak Street Health, as well as home health care provider Signify Health. So its cost base seems to be changing, and that's why it's then trying to cut down on costs. So, we'll see how the kind of mix continues to go here. Even as its pharmacy business itself seems to be doing okay. Revenue overall, by the way, was up by 10%. So a little bit of good, a little bit of bad.
Exactly, but it's balancing out in the shares. We're watching shares of Yum after the fast food giant saw same store sales, that's a tongue twister, always, that's why I say comp sales, rise 9% year over year, driven by a 13% sales jump at KFC as promotional efforts paid off. Now, this stock has been fluctuating a little bit. It was earlier a little higher. Investors, again, trying to digest, pardon the pun, actually don't pardon the pun, its results. So it did, there was one interesting tidbit in its earnings that stood out to me in terms of digital sales. I'm like, why are people shopping at these,
Because you order online.
But it's food. I don't
order?
No. Well, the only place I do the app is like Starbucks, which we did,
You don't do DoorDash or?
Well, not for fast food. Why would you DoorDash KFC?
A lot of people do that.
I know.
Or they order it ahead and then they go and pick it up, just like your Starbucks.
Okay, that's fine.
So
or
they don't
pick up, but I
wait
just
it
feel
up.
like that is
Wait
so
for it.
lazy. But apparently, it's record digital sales. Record.
Everything's digital now, baby. That's the way it's going. A couple of things that stood out to me, too, is maybe putting some pressure on the sales here. The comps overall, to your point, did beat estimates. I say comps, too. It is easier. Pizza Hut comps, though, missed estimates. They were up by 4%, but analysts were looking for more than 6% gain. And Taco Bell comps missed a little bit, up 4%. The estimate there for a gain of 4.6%. So despite the much touted return of Mexican pizza, it doesn't seem to.
No. KFC is the winner. Pizza Hut.
Exactly.
KFC's in, Pizza Hut's out, apparently.
So I guess so. There's another mover that I want to talk about that really caught my eye this morning, and that is Generac, the generator maker. The shares down almost 15% after it warned it expects sales to fall more than expected this year. Now it's looking for a decline of 10 to 12% in sales this year. It had forecast a decline of 6 to 10%. And all of this seems to be in its residential business, not in its commercial business.
They said that, exactly.
But this is, this is really a big shift here.
It is, and the CEO mentioned softer demand for consumer demand for home improvement. So to your point about the residential business, and you wonder if some of that is that story about like the decline that we've seen in people just doing home improvement projects. But still, even with today's sharp move, year to date, the stock is still up 30-some-odd%, or around 30%. So, so it's certainly not completely tanking shares, but a big miss in terms of, both the sales decline and then expectations going forward.
Yeah, it's so interesting to me, all of these stories that were the pull forward pandemic stories, right? This is one of these things where people were buying generators during the pandemic. Because they were at home, they felt like they needed that backup. And we're still sort of surprised.
Right.
Or at least surprised by the magnitude.
Right, because the trends were so strong then, you felt like there was, a tailwind to it.
Yeah, and that it would be sustainable to some degree at least. But here, this magnitude of this decline is really something. The company does say one small bright spot here is that it says its commercial business is going to hold up better. So, maybe that's something that could help cushion some of the blow from the decline.
residential side.
I mean, if you look at the mix between the two, it's actually relatively even. So residential products net sales in the quarter were down 44% to $499 million. Commercial and industrial up 24% to $384 million. So a little bit better on that point.
Yeah, but not enough for the stock today.
Yeah.
All right. Well, we have more of your market action ahead. Stay tuned. You are watching Yahoo Finance.
Is recession still on the table? It seems like soft landing is purely in the cards right now. Is that true?
Yeah, look, we couldn't have asked for a better Goldilocks type scenario, at least for now. We're seeing inflation moderate, and that's not only headline inflation, we're seeing early signs of core inflation moderate. This comes even as economic growth is holding up better. So you can have an environment where growth in the US is still in that above trend 2.5% range, inflation moderating, and by the way, earnings holding up better. And we have a Fed that potentially, and really global central banks, thinking about stepping to the sidelines. We do think this year, pivoting lower to rate cuts unlikely, but next year, the Fed has already told us that they may be considering cutting rates. So you have an environment where interest rates may be headed lower, inflation is trending in the right direction, and growth is still holding up. That to us is a soft landing.
The U.S. has been stripped of its top-tier credit status by Fitch Ratings, the credit agency downgrading to the U.S. to AA+ from AAA. Now, the last time this happened was 2011. Different agencies started it then. Yahoo Finance's Jared Blickery joins us now. Jared, I was covering this then. You were trading it in 2011. So talk to us about what it looked like then.
Traders were really skittish back then. Over the summer, Greek debt and periphery debt in general, those yields and spreads had exploded such that their debt was a lot more expensive. And then the problems come home to roost in the U.S., or so it seems, because the S&P, they downgraded U.S. debt at the time. Excuse me here. I want to show you the charts as they existed at the time. This goes all the way back to 2007. So this orange line is the S&P 500, and this dotted line here coincides with that August 5th date that S&P downgraded the U.S. debt. Way back in 2011, the S&P was trading at about 1,200 and the 10-year was trading at about 2.5%. That would be right here. What happened from there? Well, stocks actually sank a little bit and they fell into what the media would not call a bear market, but it was 19.5% down from close to close, so might as well have been one. Markets were very difficult to trade, but a few things happened that stabilized the markets. We had Jackson Hole, that was in late August. Bernanke came, tried to reassure the markets the way he had the year before. We were not currently doing QE at the time, so that was kind of a dead issue. But the Fed would go on in October and November to institute Operation Twist, and that was where they would buy longer dated U.S. Treasury debt and sell the shorter debt. All in all, we did see Treasury yields fall, and as Julie was pointing out earlier in the hour, that was kind of a non-intuitive move. But when you consider the Fed's reaction and how they were buying and supporting the Treasury market, that might make sense, because as yields go down, that's indicative of buying interest. All in all, the market found its footing and was back at record highs in 2013. Right now, today, we are just a few percentage points shy of record highs. I'm going to show you the S&P 500. This is actually a much shorter time frame than what we were just seeing. We're not even a year out from the lows that we saw last year, but in 2011, we were a couple years back from the lows. Those lows came in early 2009. So very much a different situation. We're seeing stocks under pressure today. I'm going to look at a couple different markets. We're seeing yields up today. So that's actually that's actually the opposite of what happened before. And this is something that I really want to keep an eye on. This is the 10-year T-note yield over the last 2 years. This is a 4% level. This is the big one that we're watching right now. But guess what? 5% is way up here. And when you consider that this may be just a basing action and priming for the market to head higher, that technically is actually probably the highest probability scenario for me. So if 10 years shoot up, the 10 years shoots up even farther, that's going to present a lot more hiccups for the market than downgrading the U.S. debt, because I'm not just seeing that in the market's reaction just yet. Another thing that happened back then was gold. I'm not seeing gold prices move today. Let's take a look at that. Gold was actually coincidentally near the highs of the time, pretty close to the all-time highs. Way back in 2011, it would shoot up to those highs, and then it would slowly sink to other levels. But right now, gold is kind of flagging up here. You could call that a bullish consolidation as well. But we're just not seeing. Here's an intraday look at the gold market. Just not seeing too much action that would say, yes, there's a huge problem in the markets.
Good stuff there. We appreciate your deep dive as usual, Professor Jared.
Thanks, Jared. Thanks, Jared. Well, soaring energy prices last year are affected more than just your wallet at the pump. They fueled oil companies' bottom lines as well, demonstrated in Fortune's annual ranking of the world's biggest companies by revenue, the Fortune Global 500. For fiscal year 2022, Walmart took the top spot again for the 10th year in a row, in fact, boasting $611 billion in sales last year. But major oil company Saudi Aramco is number 2 on the list, up from the 6th position in 2021. For more on this, we turn to Allison Chantal, Fortune Editor-in-Chief and Chief Content Officer. It's funny because already we had seen oil prices start to go down last year. But, the revenue at companies like Saudi Aramco still went up.
Massively. The revenue went up 51% last year, which was that 6-point position boost that you saw on our list. I mean, I can't stress enough, Saudi Aramco is a monster. It's a behemoth. It had $159 billion worth of profit. By comparison, Apple was just under $100 billion in profit. I mean, this is the most profitable company in the history of companies. So they are, they're able to pump gas much cheaper, pump oil much cheaper than you can here in the States. That is to their benefit. And you're seeing all of the oil companies boosted pretty significantly on our list this year.
And this year there was an increase in the number of U.S. companies on the list, correct?
Yes, the highest since 2010. So the U.S. had a good year. We performed pretty well globally. China and the Greater China area is also on the rise. Europe had a pretty weak year. The euro, I think, is to blame. We expect to see it rebound a bit next year as things sort out there. But yes, the U.S. had the most companies on, about 136.
And then there's the role of big tech, which we talk about all the time. People sort of raise eyebrows at how dependent the rally here has been on big tech, for example. Big tech also has a big presence on the list, as you might imagine.
It does. And, it's hugely revenue generating, profit generating. At the same time, I think while this year is steady, and Walmart was number one for the 10th year in a row, I think next year you might start to see the seeds of a lot of change. I mean, Saudi Aramco nearly knocked Walmart off its perch. The revenue generated was within $20 billion. Definitely can close that gap if the trend continues. In big tech specifically, though, you're seeing AI hasn't really been felt in the numbers yet, and that trend will play out for the next 5-10 years. I mean, come 10 years' time, you could see a massive unseating in tech depending on the decisions that their CEOs make right now.
Besides, speaking about the numbers, besides revenue, what are the other metrics that you all measure when compiling this list?
So revenue is the primary. I mean, you could argue that you could do the biggest companies in the world based on profits. That's not what we do. Otherwise, Amazon would not be number 4. It would be not even on the list. So we do it by revenue. We always have for 34 years. This is how we've done it. This is also how we do our Fortune 500 list, which is just the U.S. companies, and we did that 2 months ago. We do look at profits. We look at year-over-year growth. Those are the primary factors.
And how should people use the list, right? Like, it's fun to talk about, right? It's interesting to talk about the size, both for the Fortune 500 and the Global 500, sort of as a tool as well. How should people think about it?
I mean, I think people should look at the overall trends. I mean, so this is the most revenue generating year in 2022 that we've ever seen. $41 trillion in revenue generated by these companies. That's a third of the world GDP in those numbers, and that's concentrated in China, Japan, and the US.
Do the numbers ever go down? Do the revenue, have there been years when revenue has fallen?
Profits have, and profits did this past year. The revenue has just been ticking up.
Yeah.
And when you compare 2021 to 2022, were there any big surprises to you when you were kind of like heading into the 2022 year?
I mean, I think we knew that energy would be a big sector, but I mean, really, just to see the 40% increase really across the board, whether that's Shell or that's Exxon or that's Saudi Aramco, I mean, that was huge. I think to see the sheer size and scale of Saudi Aramco, I mean, the profit size there is just so big, and the ramifications for that are so big. I mean, Saudi Arabia has so much money to spend because a lot of those profits go into the public investment fund. And they say that they have over $3 trillion to spend by 2030. I mean, a lot of businesses are going to have to be making decisions of, do we want to do business with Saudi Arabia? That is a whole bunch of cash that we're looking at. So things like that, I think, really stand out.
It's difficult for people to resist.
Yes.
Especially golfers.
Yeah. Exactly, apparently so. All right, Allison Chantel, Fortune Editor-in-Chief and Chief Content Officer, thank you so much. More of your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Has there been one overwhelming theme to this earnings season?
Yeah, I'd say we're about 50% through earnings season, and the theme has really been about 80% of the companies have beat earnings on a bottom line basis. So it does feel like the trend we saw in Q1 continues through Q2. Now, we're still down negative 7.5% or so thus far, year over year on an S&P earnings growth basis, but slightly better than expected, and the trend is supposed to improve in the second half of the year. So I'd say net-net, the good news is we are seeing better margins and better earnings overall in the second quarter.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving. Stocks are under pressure as a downgrade to the U.S. credit rating hurts investor sentiment. Fitch moved to cut the rating from AAA to AA+. This is only the second time this has ever happened.
And looking at some top movers this morning, we're watching Kraft Heinz after the company's sales took a hit from higher product prices as inflation continues to affect consumers. Kraft Heinz price hikes drove a 7% decline in volume.
Match Group shares are also in focus today on the move, gaining ground after the company forecasted revenue for the third quarter above expectations, getting some help from Tinder.
And shares in EA falling after the video game publisher's revenue forecast for the current quarter fell short of Wall Street expectations. EA seeing second quarter earnings between 72 cents a share and 89 cents a share. There were some bright spots, however. Sales of its FIFA soccer game did hit a record. Well, the U.S. has been stripped of its top-tier credit status by Fitch Ratings, the downgrade from AAA to AA+, coming as a bit of a surprise. Fitch writing in a statement, the move, quote, reflects the expected fiscal deterioration over the next 3 years and credits, quote, erosion of governance and rising deficits as causes. For more on this, we turn to Gina Smilek, New York Times Federal Reserve and economy reporter and author of Limitless, which is about the Federal Reserve. Also with us, JJ Kinahan, IG North America CEO. Thank you both for joining us. We appreciate it. Gina, I want to start with you. This did take some folks by surprise, even though Fitch had already put the U.S. economy on watch for a downgrade, or the U.S. government, I should say, on watch for a downgrade. What's the kind of reaction that you're hearing about this morning, and how are you sort of framing this?
Yeah, I think there's a little bit of confusion both among sort of policymakers in Washington and also among sort of the analyst class on Wall Street about why this happened now. Janet Yellen, the Treasury Secretary, called the timing a bit arbitrary. Clearly, the thing that has sort of caught Fitch's eye is some combination of political brinksmanship and the fact that the debt limit debates have been happening with just so much animosity over recent years, but also the fact that we have, such a big and growing debt burden and deficit expansion here in the United States. And so, I think the question that's kind of on everybody's minds is sort of why now? But, I think it may be a while before we have a very clear answer to that.
JJ, Gina brings up a great point, that point about why. It's not so much the why now, because this was signaled to come. So, JJ, what does this do to investor sentiment, in your opinion?
Well, it's interesting to see the market today. Yes, it's down, but we still continue on this streak. Coming into today, we had 47 consecutive days of trading days where we were down less than 1% on the S&P 500. We're flirting with that at the moment, I guess, on the back of just talking about Match.com. That makes sense. But overall, we still haven't gone down more than 1%. We do see a little bit, the VIX, up 10% today. So a little bit of concern there. But overall, I think the market, I won't say is ignoring it, but I certainly don't think you're seeing the kind of reaction you might have expected if overall the market was very panicked about this news.
Yeah, it seems that way, JJ. And I wonder if investors are more focused, their attention is more sharpened right up in the run up to, say, the debt ceiling debate, for example, which is what was linked to the last credit downgrade for the United States. So do you think there will be any sort of longer term effect in the market from this downgrade?
Well, I do think, the amount of debt we've taken on in a very short amount of time, at some point, we're going to have to reckon with that, if you will. But in the shorter term, at the end of the day, it's still earnings that drive markets. And we're in the middle of a really good earnings season overall. Coming into today, 83% of the stocks had beaten, albeit many of them on lower expectations. And as we're continuing to see, employment is staying strong. Obviously, on Friday, we'll get another reading on that. But from ADP this morning, it looks like this market has been incredible in terms of, think about where we started the year, think about all the bad predictions for everything that would happen all year. Very few people are calling for this kind of a rally. So this really has been an incredible case in resilience. That being said, again, debt is something that you do have to deal with at some point, and we're not exactly doing the best job at that at the moment.
So, Gina, this is a great pivot. So we have new numbers on jobs showing, ADP report showing 324,000 jobs added. You know, when we think about last month, and certainly there was a difference, a divergence between ADP and the government's report. What does this do? I know you recently wrote about the soft landing scenario. What does this do for that possibility?
Yeah, so the ADP numbers are really interesting because ADP revised how they calculate these numbers last August, so about a year ago now, and they don't tend to match super well with the government payrolls report, which is the one that we're about to get Friday, which is what Wall Street tends to pay more attention to. But what ADP does tell you is sort of the general direction of travel, and I think the general direction of travel here is a very good one. It seems like we are still doing a lot of hiring, unemployment remains very low, people are coming back into the workforce in ways that we didn't expect. And all of that adds up to a situation where this economy has a lot of resilience, even as the Fed tries to slow it down. And so we have seen some of that slowdown that was meant to happen, that was engineered, but we haven't seen a huge cracking in the economy that would plunge us into recession at this point. And so I think in general, it's been a very good news story recently.
You also wrote recently, Gina, about the soft landing optimism, which you're expressing, but that we have seen soft landing optimism in the past, and it hasn't insulated the economy from a recession. So how do we know that that's not going to happen this time?
Yeah, so it was funny. I was talking to Gennady Goldberg, who's a strategist at TD recently, about sort of all the soft landing optimism. And he was telling me, it's funny if you go back and look at the clips from the last couple of recessions, right before those recessions happened, people were calling for soft landings. And so, of course, I did that. And I went back and sort of climbed through the New York Times archives. And it is true that before all three of the last recessions, people were very confidently saying, we've achieved victory and we are not going to have a recession. And that this is the mythical soft landing. And so I think it's just a real reason for humility. Like, it's clearly the case that it often seems like you've nailed it right before you plunge into recession. And so I think that's a reason to avoid being too confident about any forecasts at this stage.
JJ, I want to ask you about your clients. Are they playing this market as if there is a recession in the cards, or is it kind of out the window now?
No, I think people have been pretty optimistic. Gina's point, I mean, as they say, you get knocked out by the punch you don't see. But right now, it is a little bit difficult to see that we are headed to recession. With that said, if I look at our clients, obviously, you see elevated activity as you would expect in Apple, Tesla, NVIDIA, as this market has climbed up. What's been really surprising to me is two major trends that we've seen. The first one, if I go back 2 months ago, what we were seeing a lot of is our clients, and before that, trading indexes and index ETFs, be that through equities or options. What we've seen over the last 2 months is more belief in the rally as we started to see many more single names. So we went from almost a 50% index trading to back down to a more historical 30 to 35%. The rest going to individual names. I named some of the three there, but the two that have been the most interesting to me over the last 3 weeks have been Microsoft, where we've seen 75% more trade in that period, and Netflix, which has really been amazing, where we've seen 125% more trade in the last 3 weeks. So those two names particularly have seen a lot more bullish activity. They performed well overall. But along with that, we started to see it spread out a little bit more in terms of the individual names besides those, many are calling the Magnificent Seven, onto, some of the energy names, et cetera. So I think it's a really healthy sign for the market overall when people are starting to spread out their investments a little bit more. When people are very unsure is when they go to the index-based trading. The fact that we're starting to see more normalized trading, to me, is a very good sign.
On the flip side, JJ, what we're also seeing today is a decline in those very same tech stocks that people have been getting into. And I just saw a headline that the 10-year yield is now at its highest since November at 4.09%. Whether it's because of the downgrade or other factors, how much of a headwind are we going to see that come back as a big headwind for big tech?
You could, but, again, keep in mind where we started. When you have this many, we've had an incredible rally. We haven't had any real sell-off in over a month. part of the, I actually think it's always healthy when you get a little bit of a sell-off after these run-ups, because the longer you go without one, the more drastic that sell-off tends to be. So I don't think that's necessarily a bad thing. I do think, though, in terms of relating that 10-year to inflation, et cetera, if you look at the yield curve, we still have that 2-year over the 10-year. And in my opinion, for us to really say, okay, we have a chance to have a great rally, we're going to have to see a normalized yield curve, because what that will allow is for the financials to truly participate. Yes, higher interest rates are good for financials, but again, when you have that shorter term rate over the longer term rate, it's not to the place where you want for them to truly perform.
And then finally, Gina, to circle back around here, with this Fitch downgrade happening, any chance of DC taking notice and getting along better and getting stuff done? I'm laughing, but I got to ask the question.
It's a fair question. No, I think the answer to that is basically a negative. Pretty much every economist note that I've read today says basically the upshot of this is nothing changes. It doesn't add new information that we didn't previously know. It doesn't put enough new pressure on the political sphere to actually sort of change anybody's positioning. And I think we kind of saw that last night, after this downgrade happened. You saw some commentary rolling in from the Democrats and the Republicans, and they blamed each other for it. And I think that's basically where we are.
I wonder what actually would put pressure on them. Maybe we'll never find out. I don't know. Gina Smilik, thank you so much from the New York Times, and JJ Kinahan of IG. Thank you so much, guys. Good to see you.
Thank you.
All right, let's do a check of the market sponsored by Tasty Trade here. We do have all three major averages down. You just heard JJ talking about the streak that we have seen for the S&P 500, where it has not seen a decline of 1%. We might break that streak today. The S&P off 1.04%, but the Nasdaq is leading declines, off by 1.76% as those Treasury yields climb higher. We've got much more coming up. Stay tuned. You're watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
this AI wave is going to be the biggest that anyone has ever seen. I think that the success of OpenAI is the point of evidence that this is going to be one of the fastest growing moves, not just in the consumer market, but in the enterprise market.
That was my conversation with Salesforce co-founder and CEO Mark Benioff back in June. Earlier this year, he told me the tech giant wanted to be the most profitable software company in the world, that he was ready to hit the hyperspace button as well. He was also trying to outmaneuver a string of activist investors like Elliott Management and Starbird, urging him to cut expenses and boost profits. One of their big complaints was the lack of a clear integration between Salesforce's core products and some very pricey acquisitions. At the top of the heap was Slack, a messaging service acquired in 2021 for $27.7 billion. The deal is meant to make the business more connected than ever before. Now, under the leadership of CEO Lidiane Jones, Slack has leaned into the world of generative AI. It's 2 years after this mega deal, and with a new leader at the helm, has the Slackification of Salesforce actually happened? Let's dive in here with Lidiane Jones, Slack's new CEO. Lidiane, welcome to Yahoo Finance. Good to connect with you here. 6 months into this job, what is the state of Slack and what is the state of this business inside of Salesforce?
Brian, thank you for having me. We are seeing incredible momentum from our customers that are really bringing to bear the Slack intelligent productivity platform across every line of business. And today we are announcing a brand new integration, native Sales Cloud integration into Slack, which really showcases the power of bringing productivity for the customer base that Salesforce has been, a great leader over the course of the last 25 years. So it's an exciting day to showcase what we can do across our products.
Has the holy grail of this integration between Slack and Salesforce been realized, or do you need more time?
We certainly are seeing phenomenal customer feedback and excitement for what we can do with products like this. So we are already innovating, bringing Slack and Salesforce together in great brands like Ford, IBM, Target, that are really transforming automation and connecting teams with Slack and connecting all of that incredible CRM data directly into our product. So really bringing collaboration in CRM to supercharge productivity for their businesses. So that's been a phenomenal proof point, Brian, that we are excited to continue to drive forward in the quarters to come.
I think the team a couple weeks ago garnered a lot of excitement on the street regarding pricing for new generative AI tools. How does the pricing for this product get weaved into a broader Salesforce product?
Certainly we are excited to focus on augmenting our pricing to launch a productivity gain for revenue teams. So we will price per user as we have on our Sales Cloud products, but bring consumer grade, consumption grade pricing for AI on top of that. So it is just very aligned with the rest of the pricing strategy for Salesforce.
How are these new advances on Slack and in broader work from home tools as it pertains to AI, how are they going to change my working life?
Brian, as you and I am sure experience and many of our customers, there's just a lot happening. Teams are trying to be more productive, trying to do more with less across every part of the organization. And AI has really become a tremendous innovation proof point. So, we can now bring in Slack native AI experiences that will help you catch up to your work. So, email referencing to be able to bring insights. So if you go into a channel and there's a lot of conversation happening, you can catch up on threads, you can catch up on what you have missed maybe in the last week. It just really accelerates productivity for everybody on the team. So we are really excited about that. But we have also seen a lot of our customers use our open platform to develop AI-led automation as well. So we are seeing a faster adoption to automation. We're using our platform for every part of the organization.
Having covered Slack for a long time, I know small businesses are very important to your platform. We just had a pretty strong ADP employment report earlier this morning. Small businesses leading the charge. What are you seeing from that customer base right now?
Over the course of the last several quarters, we continue to see a very rapid growth of new organizations adopting Slack. So we really measure, Brian, how many new teams and customers are choosing Slack at our SMB self-service business, and that number continues to grow. So we see that as a great sign that the small business economy is revamping up, and it's been a really exciting number to see.
And a lot of these small businesses are joining larger businesses and mandating people go back to the office. Lidiane, there's really this, I think, old guard trying to get human beings back into offices for creativity purposes or just to flex their own muscle or their own leadership baton. How is this impacting Slack?
Brian, we launched a State of Work report a couple of months ago, and there is certainly a desire for more people to go back to the office, but we have seen from employees as well that there is a need for connection. So what's been most effective, and certainly what we are adopting in Slack and many of our customers are, is using more purposeful time together in the office, where people are really coming together, not just to be there with people they don't work with every day, but rather really be there for actions that will help them all succeed. So for us, it's been onboarding employees. It's more effective to do that in person. It's in product planning. It's a more effective, and teams really needed that connection to feel, understand the culture of their organizations, to feel connected to their colleagues, and to accelerate their decision making. So that purposeful time in person has been very impactful. And what's been great about Slack is that we are a platform that supports this hybrid work environment. So customers are taking advantage of the platform to support this evolution of how we all, work together.
And Lidiane, I would argue you are now leading the most important acquisition, the most important business inside of Salesforce that they have acquired in the last decade. Again, that's my view. Tell us a little bit about yourself. How did you get into that seat?
Well, Brian, it's an honor of a lifetime to lead a product that is as loved as Slack is in an organization like Salesforce that customers truly believe and bet their companies on. So it's a tremendous opportunity. And, I think what makes me the right person to lead this team is that I've been here with Salesforce for 4 years. So I understand our Salesforce customer base, but I have also been a customer of Slack for the last 7 years. So bring the best of both worlds is our vision, really bringing Slack as the front door of experiences for all of our Salesforce customers is what we're aiming for. And so I'm thrilled to be leading this team.
What's your biggest hope in terms of leading Slack, and how would you describe your leadership style?
I really believe in doing what's right for our customers first and foremost, and it's very aligned with our values of customer success and trust. So what I envision for the future is that we are going to transform how every part of our customer 360 of Salesforce, how work is done. And we believe it is, I certainly believe that it is all of our teams coming together. It's the sales team collaborating with the service team and the marketer team. So really bringing the connecting tissue that will help companies break organizational silo to be more productive and better serve their customers. So I'm excited to bring that vision to bear. I think it's been an exciting 6 months and just the beginning of a optimistic and future ahead.
All right, well, good luck on your CEO journey. Looking forward to seeing you potentially at Dreamforce in a couple months. Lidiane Jones, Slack CEO, we'll talk to you soon.
Thank you, Brian. See you soon.
Appreciate it. All right, do stay tuned. More stock market analysis straight ahead. Big day for the markets.
Apple is all set to report this week, and investors are going to be watching that very closely. What type of bellwether could Apple be?
Yeah, look, Apple is one of probably the top company in the S&P 500, close now to an almost $3 trillion market cap. And in fact, it will likely be a bellwether, not only for the tech industry, but also for the consumer. Keep in mind, the iPhone is probably one of the most recognized consumer brands globally. And of course, a lot of investors are curious on the health of the consumer. Now, what we will say broadly on the tech trade generally, we've seen a very fast move very quickly in the first half of the year. Valuations do remain on the high end of the range. Could we see a bit of volatility? Yes, but we do think there's a long-term theme behind tech, AI, and hopefully some of that volatility brings opportunities, especially for those that haven't been involved in this tremendous rally in the first half of the year.
Fitch has downgraded the U.S. government's credit rating. This is only the second time that has ever happened. The first was back in 2011. That's when fellow credit rating agency S&P cut this rating to the same level, AA+. Fitch now says its move reflects an erosion of governance, which has manifested in repeated debt limit standoffs. Joining us now, Mohamed El-Erian, Allianz's chief economic advisor, and Mohamed was formerly CEO and co-chief investment officer at PIMCO. He's also the president of Queens College Cambridge. It's great to talk to you as always, Mohamed. You said in a tweet that you were puzzled, certainly by the timing of this. I wonder, though, if you are as puzzled by the fundamental case that Fitch is making here, that there is so much dissent that this is really holding back the U.S. from a fiscal perspective.
So the only response I would have to this is why now? What Fitch put in their statement has been true for a while. So why now? And that explains the reaction that I and many others have had, which is first, this is surprising. Second, when you look at the reason, you scratch your head as to the timing of this. And then thirdly, which is most important for our audience, is the expectation that this will have minimal impact on the things that are sensitive to ratings. In particular, the credit default swaps, the currency, and the yields. So, surprised, but then expecting the market to brush it off, which is exactly what has been happening this morning.
It has been happening to some extent, but we are starting to see yields creep up a little bit more. I saw a headline, they're at the highest now since November. So again, yes, why now? I get that argument, but how much of a problem is the dissent in the U.S.? And there's even been reporting that the team at Fitch was really spurred, although again, very late, by the events of January 6th and sort of what that symbolized about what was happening in this country.
So January 6th is a long time ago.
Yeah.
So to be spurred now by something that happened 2 years plus ago is a bit surprising. Look, yields are going up for good reason. And it started before the Fitch announcement, and it's continuing. And the good reasons are twofold. One is that consensus has revisited the outlook for U.S. growth and has become more bullish or less pessimistic about U.S. growth. We had another major announcement today that took recession out of their projections, the Bank of America. And then the second issue is I think people are starting to look at the inflation over the medium term, and they're starting to realize that it's going to be really hard to maintain the 2% inflation average over the medium term, that there are fundamental changes going on the supply side that make it more likely that inflation will be higher than 2%.
Mohamed, speaking of your tweets, there was another tweet where you talked about looking at different variables to assess the impact of this and, why this was even necessary, from bond yields to, let's talk specifically about the dollar. Yes, not much movement there, but you also have some support from some economic news out today with regard to the dollar that's supportive there. But what does this do to the dollar, to you, in your mind, from your perspective, for its status as the global reserve currency?
Yeah, and that's the political side. So the economic and the market side, I think, is clear. Then there's the political side domestically and internationally. Domestically, this is likely to fuel more of the polarized conversations that are going on. Internationally, for the adversaries of the US, they will point to that as yet another development in terms of the US no longer being as powerful and as influential. I think that those arguments are weak, but they will be used by that. I think it's interesting that the dollar, the DXY index today is stronger rather than weaker. If people were taking this Fitch downgrade as a serious signal, we would expect the DXY index to be weaker. In fact, it's back up above 102, as you know.
Earlier in the show, we were sort of combining the Fitch downgrade with the latest former President Trump indictment, again, as these signs of cultural and political dissent in the U.S. As we head towards another election, how much do investors need to pay attention to these issues?
So you need to pay attention to geopolitical and political risk factors. But then you have to make an assessment as to will they fundamentally influence the way the US economy behaves. One of the big advantages of the US economy relative to others is that the private sector is incredibly vibrant and tends to operate well under different governance developments. You know, if we start taking governance into account, then we're going to start worrying about a lot of countries, because the US is not the only one to have a polarized conversation going on. There's many other countries that are having difficulty forming governments, forming stable governments, let alone controlling their narratives.
Mohammed, besides governance, one of the things that Fitch cited in their decision was medium-term fiscal challenges, namely the impact of the aging population on expenditure programs. So, you know, saying over the next decade, higher interest rates and the rising debt stock will increase the interest service burden due to this aging population, rising healthcare costs. CBO projecting that these interest costs will double by 2033 to 3.6% of GDP. So given that kind of argument for it, just, I guess, playing devil's advocate with this question of why now, but does this matter more than down the line?
So many of us have worried about the longer term fiscal outlook and the need critically to promote high, sustainable, inclusive growth. We don't have a debt problem as long as growth continues to pick up. And one of the upside surprises has been not only that actual growth has picked up, but the potential growth is starting to be positively impacted by policy. And that's a really positive development that we haven't seen for a number of years. So yes, we should focus on the longer term debt issue. The solution to that comes from economic growth and the need to revamp economic growth models. Most of the economic growth models in place today in the US, in Europe, in China are less potent and need to be revamped. And that's what I would focus on. And ironically, again, going back to the issue of timing, this comes after better than expected US growth numbers and after people have revised up the outlook for economic growth.
So let's turn to your outlook for economic growth, Mohammed. Are you in agreement here that things are fairly solid at the moment, but not only that, that we could indeed have a soft landing and avoid a recession? What's your current thinking on that?
So, you know, I've been consistent over the last year saying there is no reason for the US to fall into recession. If you look at the US economy on a standalone basis, endogenously, it is vibrant enough, it is flexible enough, and is handling this global soft patch well. Is there a risk? Yes, there is, but it comes from another policy mistake. My greatest worry is that the Fed will over-tighten, that the Fed will continue pursuing an inflation target, 2%, that makes less sense for today's structural and supply side elements. If we were to sit down and try to formulate what is the ideal inflation target for the US economy, I doubt that we would come up with 2%. We'd come up with something closer to 3%. It acknowledges the change in globalization, it acknowledges the state of our labor market, it acknowledges the changes in supply chains, and critically, it acknowledges the energy transition. The problem, as you know, is that it's very difficult for a central bank that has been missing its inflation target to announce a change in its inflation target. So I understand why the Fed doesn't want to talk about this, but the only reason we would fall into recession, absent some massive geopolitical shock, the only reason we would fall into recession is if the Fed is so focused on 2% and wants to deliver it quickly that it over-tightens.
As you say, Mohammed, this has been your concern for quite some time. We've been talking about it for a while. The Fed has been tightening all year. The economy's going okay. So what now does that policy mistake look like exactly? In other words, is another increase a policy mistake at its next meeting? Would it have to be further than that? Give us some sort of details around what that would look like.
So first, as you know, I wouldn't have hiked in July, and I certainly wouldn't hike in September. But then there's a more fundamental issue, which is what I regard as excessive data dependency by the Fed. Yes, you want to look at the data, but you don't want to be driven by backward-looking data when your tool acts with long and variable lags. Okay, so you have to have a strategic view of the economy as to where it's going and where is it likely to settle down on that. So I would critically start moving away from this excessive data dependence, because my biggest fear, Julie, is by the end of the year, headline inflation will start turning up again. And at that point, the Fed, if it continues to be excessively data dependent, will be put in a really hard position. And that's what we don't want that. We want the Fed to take the long view, to target the medium-term inflation and make sure that we don't unnecessarily damage economic growth in response to short-term data.
Mohammed, I want to ask you about the potential impact, longer-term impact, I suppose, to treasuries given the Fitch move. Does this create any kind of destruction of demand to, say, long-term treasuries or short-term treasuries?
Not by itself. You know, Diane, one of the big questions is, what do you replace the U.S. Treasury bonds with? A critical aspect, as you know, in financial markets is they often solve in relative, not absolute space. People have to hold something. And often people are very tempted to say, this is no longer any good. And then you say, well, what is it being replaced by? You cannot replace something with nothing. And so far, there is no single other country that can replace the US in terms of reserve currency and in terms of the most liquid financial system. So I don't think that this Fitch rating changes anything, because if you were to apply the same criteria to other countries, you would probably downgrade them as well. And Fitch is going to have an issue now that it has put governance up front when asked, well, what about these countries that can't form governments? What are you going to do with them?
That is a great point, Mohammed. Finally, to end it on a light note, as we like to do, just like there's no replacement for treasuries, there's no replacement for the Jets in your heart, as we know. And full disclosure, full transparency, I am not a big football fan myself, but people on this team want to know if you think Aaron Rodgers is going to help the Jets win this year.
If we have a good offensive line, he can help us break what has been a terrible record for quite a while now. But there's a big if. You know me, Julie, I'm going to start like every other Jet fan with irrational hope, only to have it replaced by crushing disappointment. That is what happens to us Jets fans. The fact that we remain loyal is a puzzle to many people.
Well, you know, it's admirable, I think. Giant, are you a Jets fan too?
Switch to the Giants, Mohammed. It'll be better for you.
Wow.
I'm sorry.
No.
Listen, they're both here. Come on. Switch. Just come on over.
I've been suffering since 1969, so
long suffering.
Yeah, it's part of it. It's why
I will allow you back in.
Be a bandwagon fan. It's fine.
Definitely.
There's free agents in the league. Come on over.
All right, Mohammed Al-Arian, lifetime Jets fan. I don't think there's any change now. That's when they win, it's so sweet. Allianz Chief Economic Advisor and President of Queens College, Cambridge. Thank you. Great to see you, Mohammed.
Thank you.
We've got much more coming up. You're watching Yahoo Finance.
What is the theme of this earnings season so far?
I think the theme is that the consumer is really, really strong for internet stocks anyways. And we're in this moment where I think conventionally everyone is led to believe that the macro is so uncertain, and it is. However, I think when you look at the fundamental results companies are putting up, we're seeing really strong results, reflection of really strong consumer demand.
KCW Group last week announced an agreement to acquire Engine No. 1's ETF business. That deal is expected to close in the third quarter. It marks an expansion of TCW's relatively small ETF business and a further diversion from the firm's traditional investment in fixed income, its sort of core business. Engine No. 1 was founded in 2020. It launched its first two ETFs a year later, Vote and NetZ. Those are focused on aligning companies with ESG and decarbonization goals. This year, the firm launched its third ETF, Engine No. 1 Transform Supply Chain. That's under the ticker SUP, SUPP. Its focus is on reindustrialization of supply chains. To talk more about the deal and how it's going to fit in at TCW, Jennifer Grancio is joining us, Engine No. 1 CEO, who is going to be joining TCW as its head of ETFs. Thank you so much for being here, and congrats on this. So, Jen, talk to me about kind of why you guys decided to do this deal and what it's going to bring to TCW.
Yeah, thank you. So we built Engine No. 1 to help people invest in these major epic transformations kind of that lie ahead of us and are already happening. And this is a real proof of concept or sort of testament to the idea from an Engine No. 1 perspective that both in the private and the public markets, these are huge investment opportunities. And so we're very excited to be taking this set of NetZ on the carbon transition perspective and supply chain on reshoring back to the US, to be taking this sort of set of active products into TCW. And if you think about TCW, they have such a strong reputation for investment managers that are great fiduciaries, that are active. They also run concentrated active portfolios. And so for us, it's very exciting to move into that larger platform and kind of bring the active ETFs with us. And then there's a lot to do that TCW does today around other thematics that could be put in an ETF wrapper.
Okay, well, let's talk more about that. So you guys in your ETFs have about $600 million in assets right now. What are the ambitions for this business as you go to TCW? I understand it's early days, but kind of what's the vision here?
Yeah, it is early days, but at the same time, TCW has great capabilities on the fixed income and bond side, and they also have a range, including other thematic capabilities like AI, in the equity business. And so what this allows is we continue to build NetZ and supply chain and Vote, and those products will become TCW products and be run the same way with the same portfolio managers. But that ETF capability that we have can then get extended to other thematic strategies. And so that from a TCW solutions perspective, we'll be able to do a much broader range of thematics and ETFs, which is very exciting.
So I'm curious, and we've talked about this a little bit before, do you consider yourself to be an activist investor, or do you consider yourself to be a thematic investor? And how then does that fit into the culture at TCW?
Yeah, we think about it at Engine No. 1 on the ETF part of the business. We think about it as, what was missing in the market, what could be done better. So Vote is sort of simply a better index fund where you're always using your governance options. And then NetZ and supply chain are active. And the way we think about active, and one of the great things about Engine No. 1 Transform ETFs moving to TCW is there's great alignment on how TCW investors today think about it, which is you're running concentrated portfolios, you're investing across a system to drive an outcome, and then we want to be active owners, and we want to work actively with companies. That's not traditional activism, but it's working actively with the biggest holdings to release value and create value for investors.
I also want to ask, since these are traditionally thought of as ESG, quote unquote, areas, and ESG is having a weird moment right now, for lack of a better word, right? You had Larry Fink of BlackRock, who had been all in on ESG, sort of distancing himself from that wrapper a little bit. So as somebody who's in these kinds of investments, how are you thinking about it right now? What kind of reception are you getting from investors?
Yeah, I think in our industry, sometimes we spend a lot of time on an acronym. And what did the acronym mean 20 years ago? What does the acronym mean going forward? And again, I think maybe we're all wasting a little bit of time on that. And both from an Engine No. 1 perspective, we think of it as in industries and systems that are in transformation. So if you think about how we have energy or how we do transportation today, demand is changing. People want all electric. They want battery electric cars. And so if you leave ESG aside for a minute, that is a monumental investment opportunity. Trillions of dollars are being invested every year to change that system. So honestly, we think of it as just an investment opportunity. There's a huge performance opportunity. And so I think as investors, you don't want to be confused between labels and values-based investing versus places where there's a lot of economic value to be created. Those are just investment opportunities. And we should make sure that we understand them as investment opportunities, even if they also get other labels.
Interesting. So, because I think of it as, decarbonization, for example. There are also other reasons to do that besides profit, right? And critics of it have said, we don't want investors to be pushing a company in a particular direction for that reason. But you're saying reframe it as just the focus on growth.
I think I would say think about systems that are in transition. And if you want to win as a public company through time, you have to understand how your market's changing. And so if you make automobiles or if you make airplanes, people want more efficient and electric cars. People want more efficient airplanes. And so if you want to win and make money and beat your competitor, you need to move in line with that consumer demand. And so I think to some extent we can elevate it in some of these spaces because the demand is moving. And so now it does just become an economic issue in many cases.
Interesting stuff. Yeah. Thank you so much. It's great to see you. And again, congrats on the deal. Jennifer Grancio, Engine #1 CEO, soon to be head of ETFs at TCW. All right, thanks a lot. Coming up, Intel CEO Pat Gelsinger struck a very bullish tone during the chipmaker's second quarter earnings call, telling investors it plans to build AI into every product we make. Yahoo Finance's Brian Sazzi is going to be catching up with him on the state of play for the company and his take on the debt downgrade as well. That should be quite interesting. From Diane and I, have a great day, everybody. Bye.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West Coast. I'm Jared Blickery. Here's what I'm watching today. For the second time ever, the U.S. government's credit rating is getting downgraded, this time by Fitch. What this means for investors coming up this hour. And KFC customers drove a strong quarter for young brands with same-store sales. They were jumping 9% from last year. We're going to get a pulse on the earnings call coming up. Plus, we'll look ahead to a big interview with the CEO of Intel, Pat Gelsinger, later today. We're going to ask how his company climbed back from 2 straight quarters of losses. But first, let's take a look at the markets. And we have a down day. That comes after that ratings downgrade. Nasdaq is leading the way down 2%. S&P 500 down just over 1%. And the Dow off 265 points, 265 points. And then in the Treasury market, big deal for the 30-year, screaming higher, up 8 basis points to 4.19%. Not as high as the 5-year. That's up 2 to 4.27%. And the 10-year, that is up 6 basis points. Well, Yum Brands dropped its second quarter earnings this morning, seeing a miss on revenue. The fast food corporation saw worldwide system sales grow 3%, with KFC boosting sales, especially in China. Let's bring in Yahoo Finance's Brooke DePalma to break down the earnings. Brooke, please.
That's right. Well, earnings came out around 7:15 this morning. Then we heard from them around 8:15. And certainly it was a call that covered a lot. I mean, inflation, consumer behavior, as well as pricing power and innovation were just some of the highlights of the call. Of course, they did miss revenue estimates despite KFC seeing same-store sales higher. Taco Bell, Pizza Hut did miss same-store sales this past quarter. But the big story here, KFC seeing same-store sales move higher at 13%, largely boosted by that China reopening. But taking a closer look at what exactly was mentioned in the call, we did see record digital sales of $7 billion this past quarter, a digital mix exceeding 45%. Across all 4 brands, our digital sales were up nearly 30% year over year. In addition to that, we are seeing a different consumer behavior when it comes to how exactly they play with digital. Taco Bell here in the U.S., now 100% of locations now have kiosks. And at Habit Burger Grill, one of their smaller businesses, they noted that with the rollout of kiosks now in 60% of their stores, an average kiosk sees about 10% higher checks compared with front counter sales. They also said it was yet another proof point of the value from converting to digital sales. But one of my favorites here, they did weigh in on KFC nuggets. They said that over 100 million were sold in the first eight weeks. They said this proves that product innovation is met with positive consumer reaction. Of course, we got a first look at those last year. They do tend to skew to a Gen Z younger audience, which is awesome there as they look to really engage the next generation. And unit growth was a big story on the earnings call. They did add more than 1,000 new units in the second quarter. And CEO David Gibbs really saying here on the call that in the last 2.5 years, they added 10,000 new stores to the Yum system, and that makes up about 20% of our stores. So that's necessarily they built 20% more stores in the last 2.5 years. So lots of momentum this past quarter. Shares now slightly up.
Let me ask you then, because I know the CEO was on the call giving some insight about not only inflation, but you're talking about their expansion in locations. Where are they gaining market share?
Yeah, well, really, they're gaining market share here from a lower income audience. On the call, they gave some insight that some of those pandemic trends that they were seeing, like bigger party sizes, are now transferring back to pre-pandemic, trends, like more individual meal occasions and party sizes going back down. But the CEO, David Gibbs, did weigh in on the call about how value is a key strategy here and how it's gaining market share from that. Take a listen.
This is an environment where we can succeed. Value is rising in importance, but we have solutions and in many ways are leaders with our brands. You know, KFC for the U.S., for example, in the quarter, their most growth was seen in their low-income consumers because they had always-on value for the quarter, as I mentioned in my prepared remarks. So we can win in this environment in developed markets.
always on value. That was KFC's key strategy to gain market share as consumers look to ultimately save when dining out or look to change exactly where they're looking to dine out. But another bright spot of this past quarter they mentioned in the call is they said it's a stable, positive environment, and they think that inflation peaked in most markets here in the U.S. especially. So lots of momentum. My overall vibe of the call, I would say it was fine. I said the momentum's there, but they did miss at Taco Bell and Pizza Hut on same-store sales. So I ultimately think lots more, outlook to the second half of this year, how exactly consumer behavior continues to change, but ultimately positive momentum going into the back half.
Yeah, it sounds like a bit of good news on the inflation front. Thank you for that, Yahoo Finance's Brooke DePalma. All right, earnings season, it is in full swing with over half of the companies in the S&P 500 reporting results. Large percentage coming in strong. So where do we stand so far? Yahoo Finance's Ines Ferre joins us for a breakdown at the Wi-Fi Interactive. Where are we?
Yeah, that's right, Jared. Well, right now we are looking at Kraft Heinz, which reported its quarterly results, beating on adjusted earnings per share. Net sales at $6.72 billion. Its profit was up, but volumes were down for the quarter. Now, the company does expect volumes to improve in the second half of the year, but this is a reoccurring theme that we have been seeing with the consumer staple companies. Procter & Gamble, a similar story recently, whereby these companies have been increasing their prices last year coming into this year, and the consumer was resilient, but up to a point, because at some point the consumer pushes back by buying less. Now, if the price is right, you are seeing e.l.f. Beauty. Take a look at this. e.l.f.'s low or value cosmetics, low price cosmetics, absolutely going through the roof, beating on the top line and the bottom line for its quarter, raising guidance. Jeffrey's saying that this is another blemish-free quarter. You get the idea. 18 quarters of consecutive net sales growth. And by the way, e.l.f. Beauty year to date up 141%. e.l.f. saying that they are the #1 brand now, cosmetics in Target, with 18% of market share. Today, the stock is up 14%. And now we're going to show you what's happening with another company that is creating a market share, and that is in the commercial space industry. And that's going to be space, which is Virgin Galactic. I'm going to pull it up here. Maybe our control room can also pull it up as well. Right now, it is down more than 5%. This is after the company reported its quarterly results. Revenue coming in at $1.87 million. Forecast for its third quarter for revenue below expectations. But look, a lot of this, the earnings call, was really about the company gearing up for its second commercial space flight, Galactic 02, which is going to happen this month. 800 reservations that Virgin Galactic already has. They say that that's about a 4-year backlog. They would like that backlog to be about 3 years. So they think that it's a little bit too much of a time for these people to be waiting to go on these space flights. But also something very interesting from the earnings call as well is that research. They will be dedicating about 10% of their volume to research. That means that researchers are going up in space and they will be doing their research, and those tickets cost a bit more as well. So they're creating that vertical. Really interesting stuff.
I'm going to go as a space tourist and not a researcher, definitely, as long as I get the discount. Let me ask you, so what can we look forward to? I know we got Apple after the bell tomorrow, and Amazon as well, but there's a lot going on this week.
Yeah, that's right. So starting out with today, you've got Etsy, you've got PayPal, Robinhood, Qualcomm. We've got the list for you there. Also for Thursday, as you mentioned, we have Apple. Apple up 54% year to date. Amazon as well. Coinbase, Airbnb will be reporting. And then you've got Fubo, Frontier, Nikola, and Fisker that will be reporting on Friday. Nikola, by the way, up 33% year to date, and they sold some 12 cars to J.B. Hunt recently.
Yeah, some favorable news there. Stock's still down over 90%. So
of course.
It's all relative, isn't it, there,
Yeah.
Ines? All right, thank you for that, Ines Ferre. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Apple is all set to report this week, and investors are going to be watching that very closely. What type of bellwether could Apple be?
Yeah, look, Apple is one of probably the top company in the S&P 500, close now to an almost $3 trillion market cap. And in fact, it will likely be a bellwether, not only for the tech industry, but also for the consumer. Keep in mind, the iPhone is probably one of the most recognized consumer brands globally. And of course, a lot of investors are curious on the health of the consumer. Now, what we will say broadly on the tech trade generally, we've seen a very fast move very quickly in the first half of the year. Valuations do remain on the high end of the range. Could we see a bit of volatility? Yes, but we do think there's a long-term theme behind tech, AI, and hopefully some of that volatility brings opportunities, especially for those that haven't been involved in this tremendous rally in the first half of the year.
Let's do a quick check of the market sponsored by Tasty Trade. Everything under pressure right now in the majors. Nasdaq down the most by just under 2%. The S&P 500 down 1% and the Dow down 250 points. The S&P 500 and the Nasdaq both saw their highest monthly closes in a year quite recently. However, global markets were hit this morning when ratings agency Fitch downgraded its rating on U.S. credit. The agency cited the government's growing debt burden and the deterioration of standards of governance. Let's bring in All-Star Charts president and founder J.C. Peretz. J.C., always great to see you. I got to start out with the news of the day because that's what we're running with here. I have an idea of what you might be thinking about the debt downgrade and its effect on markets, but it's quite a bit different than what we saw in 2011. Your thoughts?
Yeah, I mean, listen, I think the market has bigger fish to fry. You know, this Fitch. Does anybody really even know that they existed? Like, let's be serious. Like, who are these people? So I think the market has bigger fish to fry. I think the market's proving that. I think that the pressure that you're seeing, we've already started to see over the last couple of weeks. We saw some strength out of the United States dollar, which has been the big safe haven. You're getting a bit there. and the S&P and the Nasdaq are under pressure. Not only are they below overhead supply from, prior cycle peaks, you could look back at the Nasdaq 100 right around 380. You look at the S&P 500 right around that 4550, 4600 level, which we are now. So this is a perfectly logical place for those indexes to come under pressure. Not to mention in pre-election years, this is sort of that lull from a seasonality standpoint, even in strong pre-election years. So this is a perfectly normal time for these stocks to correct. And let's be serious, the US 10-year yield is breaking out, US 30-year yield making new highs. When you have higher rates, that puts pressure on growth stocks, technology, communications, all of those areas that got us this far so far this year, which have been big winners driving those indexes, are going to be under pressure with higher interest rates. So you sort of have the perfect storm regardless of what these Fitch people say about anything, right? You see what I'm saying?
I see what you're saying. So let me ask you, you mentioned a bunch of different markets here. I want to focus, and you said the rates market in particular and the negative implications that would have higher rates for some of these mega caps that we have, the growth stocks, et cetera. But we have a number of other sectors that are already at record highs to little fanfare. We got industrials up there. We got SMH, that's semiconductors up there, transportation screaming higher. Tell me about some of these markets and what you're seeing in terms of the breadth of this rally.
Right. So the question really becomes, if these tech stocks and mega cap stocks are going to be under pressure, that means that the indexes are going to remain muted for the foreseeable future. Do some of those other areas like energy, like materials, even industrials that have much lower weightings in those indexes, are they going to be able to withstand the selling pressure coming from those growth stocks to be able to continue to progress? Can they do that? Or is this strong dollar, flight to safety, just so overwhelming that even those areas get hit too? That's sort of been my question coming into the back half of the year. In the first month, the best performers in the month of July were energy, financials, materials. Those were the worst performing areas in the first half. So you already started to see this. So the question was, is the selling that we're going to get in growth and tech too much for those other areas to withstand? I think we're seeing some of that today. Let's see if that sticks. But I got to tell you, a stronger dollar, if the US dollar index is above 101.5 to 102 area, if the dollar index is above that, these indexes aren't going higher, right? I just don't see that happening. The negative correlation between stocks and the US dollar has been through the roof for 6-7 years now. And to bet that that's going to stop, anybody who's tried to bet that is going to stop, and a lot of people have, pay the consequences. So I'm not going to tell you that correlation now all of a sudden is going to change. There's no evidence of that whatsoever. A stronger dollar is going to come with weaker stocks, Jared.
All right, well, let's talk about the commodities market. If we could go back to the Wi-Fi Interactive, I want to show what's happening with the Goldman Sachs Commodity Index. Big negative red candle today, but let's take a look at the year-to-date. You can see we got some liftoff in July here, and let's see if we can show the 200-day as well. We've seen commodities definitely perk up, and I've been talking to a number of other traders. Some think this is a harbinger of more inflation, a third round of inflation. What do you think, and how is this affecting the way you're approaching any markets?
Yeah, I mean, listen, part of the thesis coming into the back half was that we're going to get rotation into commodities and commodity-centric stocks as we're at washout levels in terms of pessimism. I guess we can get more pessimistic. I shouldn't say we're at washout levels, but we're pretty pessimistic levels when it comes to commodities, crude oil, inflation expectations. So my suspicion was, we could start to creep up. You've been seeing inflation-protected treasuries outperform nominal yielding treasuries, kind of hinting towards higher inflation. Oil sort of perking up. As we're recording this, unleaded gasolines get hammered. Oil, let's see if they could stick this. And that kind of goes back to my earlier question. Can we see that rotation into energy and materials and industrials that we've already been seeing, despite the selling pressure in tech? If today's any indication, the answer is no. But again, one day doesn't make a trend, but sort of something I'm watching and sort of I'm questioning. I like the commodities trade, but but the question is, what's your time horizon? Like in the coming months or in the coming years? I think that's a big difference, because in the short term, if the dollar's strong, I have a hard time seeing stocks and commodities in particular doing well in that environment.
We got one more, and I want to go back to the Wi-Fi Interactive. Talk about Bitcoin here. Interesting price setup here. Let me go to a year-to-date so we can see the latest flag. We had a little bit of an undercut here. I think you have labeled this an oops on your chart. Well, what are you seeing in Bitcoin right now?
Yeah, I mean, it's certainly not an oops. If Bitcoin is below 30,000, it's not an oops. It's not a failed breakdown. It's a breakdown is what it is. And the path of least resistance is to the downside in Bitcoin, no question about it. Think about how much good news we had between BlackRock coming in and Vanguard and Fidelity and the new ETF and this just bombarded. I don't remember there ever being such good news in Bitcoin. And in that period, Bitcoin failed to break out, right? Failed 4 consecutive weeks in a row at 31,000. I said, you know what? That's enough for me. I'm good. I got out of everything. Now I started nibbling a little bit, but if we're not able to get above 30,000 in the next day or two, I'm out completely again until Bitcoin is finally able to convincingly break out above 30 and really 31 is the big one and be able to stick that landing. In the meantime, I'd rather be not in. I'm not short, but I have no interest in being in. I mean, the downside is, you can go back to 20, go back into the teens, easy. I don't need that in my life.
I don't think I need that either. And the serious downside could be ahead if there is another big failure here. Always appreciate your time and great charting stuff here. All-Star Charts president and founder JC Peretz. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
Oh, the humanity. Humana is one of Yahoo Finance's top trending tickers and surging the most in 4 months after beating Wall Street expectations on profits and revenue for the second quarter, and also raising its EPS guidance to $28.25, which met estimates. But investors seem to be focused on forecasts for Humana's Medicare business, in which it has been investing heavily. The health insurer now sees enrollment in Medicare Advantage growing by 825,000 members in the full year, representing an 18% growth over 22 membership. Critically ahead of street projections of 775,000 members are the results RBC Capital Markets is saying. We are pleased to see second quarter 2023 results ahead of expectations amid fears of higher utilization heading into the print. And investors, they had been concerned about elevated costs due to Medicare growth, but those expenses appear to be stabilizing. Fitch has downgraded the USA's credit rating to AA+ from AAA. Bonds are shrugging off the downgrade, or at least they had been, but they're surging now, decidedly unlike the move last time that was made by Standard & Poor's in 2011. For more on this, we turn to Steve Lapley, BlackRock Global co-head of iShares Fixed Income ETFs, for this week's ETF report, which is brought to you by Invesco QQQ. Steve, you were in the thick of the global financial crisis, as I understand, with maybe two firms, but just tell me what you saw back then and how that might be a little bit different from what we're seeing today.
Yeah, Jared, I think we were in a very different environment back then. So if you recall, 2011, we were coming off of the financial crisis. We had debt crises across Europe, Southern Europe in particular. Interest rates were near zero. I think at that time, the U.S. Was viewed as the safe haven, irrespective of the downgrade. I think that's continuing today. So what you're seeing in the backup in yields, we think is largely a reflection of the Treasury supply coming in. You did have a strong ADP number this morning, but I do think there's, the amount of supply that's coming in through the refundings, we up from, I think, 96 billion to over 100 billion. The amount of issuance is going to continue to go up. Higher interest rates obviously are contributing to part of that. So I think it's more that than the reaction to the downgrade.
And let's talk about what has been happening year to date in the bond world. We've seen ETF flows, that's according to your notes, I believe, of $55 billion. About 16, almost 17 billion has been in one ETF alone. That's TLT, which tracks longer-term bonds. Just talk to me about this love for bonds that we seem to have right now.
Yeah, I think investors have reacted very strongly to the repricing of yields last year. It was a great reset in yields. We have not seen yields at these levels in well over a decade. I think investors responded by retooling their portfolios. So if you go back a few years, you would have to be in high yield to get a 5% yield. Now you can do that on the front end of the yield curve. So I do think what you're seeing flow-wise, we saw over 100 billion in fixed income iShares last year. We're at 55 this year, so we're on track to see similar flows. But in particular, investors have been moving out a bit in duration. So TLT reflects that. We've taken in around 16 billion. That, to me, is a reflection of investors saying they need to start adding ballast. It's very hard to time markets. Obviously, the long bond's down today, right? But it's hard to get the timing exactly right. But they've been strategically moving out in duration as a function of adding some ballast to their risk assets.
And in the ETF world, we saw smart ETFs rise in terms of equities, and now we're seeing similar strategies rise in active trading of bonds. Just tell me about what are some of the newer developments in the bond world and the ETFs that cover it.
I think you're starting to see, in terms of product innovation, you're starting to see more active ETFs. You're starting to see more defined payout ETFs. So as an example, we just launched just in the past month, we launched BINC, which is our income fund run by a Rick Reeder's team. That is designed to be a complement to a core exposure like the aggregate. So it allows advisors to pair a low-cost core bond exposure like AGG with a plus sector or higher income fund, which is BINC, and it allows them to be in the driver's seat in terms of how to modulate between those two. We also launched last year in August our buy right suite. So that's the cover call. People are very familiar with that in equities. We did that in fixed income with our flagship tickers TLT, LQD, and HYG. Those products on a trailing 12-month basis are generating high teens in terms of yield. So
it's impressive.
It's approaching
sounds like crypto numbers almost.
It's approaching. I think we're at 850 million across the suite. TLTW alone is 700 million. So they're growing very, very rapidly.
All right, and what's coming down the pike? What can we look forward to in the future that we might not have?
I do think you're going to see more of these tailored products. So a lot of the vanilla index exposures, those have been done. They're large, they're liquid. We are seeing those products being used very much in an active context. So you're seeing active managers using traditional index ETFs to generate alpha. What we're starting to see on the wealth side is a desire for more of these tailored exposures and active exposures. So I do think you're going to see more active ETFs. I do think you're going to see more tailored payout exposures along the lines of buy right type exposures.
Interesting. They call it a stock pickers market sometimes. Maybe it's a bond pickers market currently. We'll have to have you back to talk about more of that as it develops. Steve Lapoli, thank you for dropping by.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Has there been one overwhelming theme to this earnings season?
Yeah, I'd say we're about 50% through earnings season, and the theme has really been about 80% of the companies have beat earnings on a bottom line basis. So it does feel like the trend we saw in Q1 continues through Q2. Now, we're still down negative 7.5% or so thus far year over year on an S&P earnings growth basis, but slightly better than expected, and the trend is supposed to improve in the second half of the year. So I'd say net, the good news is we are seeing better margins and better earnings overall in the second quarter.
Fitch has downgraded the U.S. government's credit rating. This is only the second time it's ever happened. The first was in 2011 when fellow credit rating agency S&P took the rating to the same level, that would be AA+. Now, Fitch said its move reflects an, quote, erosion of governments, which has manifested in repeat debt limit standoffs. So what's the fallout for business and how capital is actually deployed? We're going to bring in now Chris Caton, Prologis Managing Director for Global Strategy and Analytics. You've taken a look at what's happened today, and there must be some kind of spillover effect in your neck of the woods. And just wondering how, in general, you're looking at this development.
Hi, Jared. Glad to be here. Sure. So Prologis is the world's largest owner and developer of logistics real estate. So many of our customers, whether it's Amazon, Walmart, DHL, this doesn't directly, I think, impact the flow of goods around the world. Now, we do acquire and develop properties everywhere around the world, and so the cost of capital matters, whether it's the change in interest rates today or the change in interest rates over the last 18 months. And we are looking forward to providing recapitalization opportunities. We're going to be an investor through this uncertainty and recovery. And we have already factored in this change in interest rates into our thinking. So in some respects, we had anticipated volatility and have priced things accordingly.
Well, sounds pretty prescient there. Let me ask you about your wheelhouse here. July Industrial Business Indicator, that's the IBI. It's showing an uptick in the goods economy. And I'm just wondering, because we're so worried about inflation with respect to the service side, is this something else that we should be concerned about, or is this actually a good thing that we're looking at?
Well, look, I think it for sure is a good thing. So for those who may not be familiar, Prologis surveys their customers on a monthly basis. We are the world's largest provider of space, and for many of our customers, we are their largest provider of space. We ask them after their activity, and we're publishing today our July report, and that figure tells us growth is not just resilient, but actually pretty good. And that's a key question I think that we've been facing this year as economic crosscurrents have surfaced and wondering what direction the logistics real estate industry might head. And so indeed, we've been calling for normalization in the market environment, and that's what we think we're seeing. For further historical context, 2021, 2022 were exceptional years. And so this normalization is taking us back to 2018, 2019 levels in a rather steady glide path, if I'm candid. And so what that's revealing to us is the importance and ongoing support that we get from the structural drivers of our industry.
And talk to me then about the supply of, I guess, real estate units on the market right here. It's square footage. I'm reading some from your report here. The true months of supply, TMS, rose to 36.5 months, and that's increased by 6.5 months from the prior quarter. Contextually, how does this relate historically? Because 6.5 months increase in supply might seem a lot to us, but historically we've seen it probably surge quite a bit more during the global financial crisis, for instance.
You're exactly right. So indeed, the industry is one that still faces scarcity. The market vacancy rate across the United States is 4%. The typical historical range is 7 to 10%. And we had, like you just said, a market vacancy rate of 10%. Through the global financial crisis. And you're right, that other metric that we maintain from a proprietary standpoint was 100 or more in the global financial crisis. So indeed, there remains scarcity. And this is a key challenge for our customers who need to plan earlier and more proactively to secure the real estate they need to ensure the efficient flow of goods around the world and into the United States. And so what this means is we have ongoing pricing power. Rent growth continues to grow in line or in many cases faster than inflation, really everywhere, nearly everywhere around the world.
Well, so if I'm hearing you correctly, it sounds like business people should be a little bit more concerned about scarcity, at least future scarcity in this market. Anything else that investors, and let me know if I have that right or wrong, but anything else that investors, people who use your services, just people in the economy in general, should be keeping their eye on?
No, you're spot on. You're totally reading the situation correctly. I think one thing that we're starting to do is peek into 2024 and ask what could happen to that true months of supply metric, what could happen to that market vacancy rate. And one thing that we haven't discussed, though, is, hey, how are new suppliers, new product coming to the market in response to this scarcity and this ongoing rent growth? And there's a little bit of a paradox here. In fact, we're seeing a complete deceleration in new supply coming to the market. New development starts are off 50% from a year ago. And this really relates to the move in interest rates and also, candidly, the cost to build our buildings and the availability of debt, say, from the banking community and how they're managing their relationships as well as their capital reserves. And so that presents opportunity and risk as we peek into 2024.
Yeah, some surprising insights there. Really appreciate you stopping by. Chris Caton-Prologis, Managing Director for Global Strategy and Analytics. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
Fitch has downgraded the U.S. government's credit rating for only the second time in U.S. history, the first being Standard & Poor's in 2011. Yahoo Finance's Julie Hyman and Diane King Hall, they spoke with Allianz Chief Economic Advisor Mohamed El-Erian to get his thoughts. Take a listen.
So the only response I would have to this is why now? What Fitch put in their statement has been true for a while. So why now? And that explains the reaction that I and many others have had, which is first, this is surprising. Second, when you look at the reason, you scratch your head as to the timing of this. And then thirdly, which is most important for our audience, is the expectation that this will have minimal impact on the things that are sensitive to ratings. In particular, the credit default swaps, the currency, and the yields. So, surprised, but then expecting the market to brush it off, which is exactly what has been happening this morning.
It has been happening to some extent, but we are starting to see yields creep up a little bit more. I saw a headline, they're at the highest now since November. So again, yes, why now? I get that argument, but how much of a problem is the descent in the U.S.? And there's even been reporting that the team at Fitch was really spurred, although again, very late, by the events of January 6th and sort of what that symbolized about what was happening in this country.
So January 6th is a long time ago.
Yeah.
So to be spurred now by something that happened 2 years plus ago is a bit surprising. Look, yields are going up for good reason. And it started before the Fitch announcement, and it's continuing. And the good reasons are twofold. One is that consensus has revisited the outlook for U.S. growth and has become more bullish or less pessimistic about U.S. growth. We had another major announcement today that took recession out of their projections, the Bank of America. And then the second issue is I think people are starting to look at the inflation over the medium term, and they're starting to realize that it's going to be really hard to maintain the 2% inflation average over the medium term, that there are fundamental changes going on the supply side that make it more likely that inflation will be higher than 2%.
Mohammed, speaking of your tweets, there was another tweet where you talked about looking at different variables to assess the impact of this and, why this was even necessary, from bond yields to, let's talk specifically about the dollar. Yes, not much movement there, but you also have some support from some economic news out today with regard to the dollar that's supportive there. But what does this do to the dollar, to you, in your mind, from your perspective, for its status as the global reserve currency?
Yeah, and that's the political side. So the economic and the market side, I think, is clear. Then there's the political side domestically and internationally. Domestically, this is likely to fuel more of the polarized conversations that are going on. Internationally, for the adversaries of the US, they will point to that as yet another development in terms of the US no longer being as powerful and as influential. I think that those arguments are weak, but they will be used by that. I think it's interesting that the dollar, the DXY index today is stronger rather than weaker. If people were taking this Fitch downgrade as a serious signal, we would expect the DXY index to be weaker. In fact, it's back up above 102, as you know.
Earlier in the show, we were sort of combining the Fitch downgrade with the latest former President Trump indictment, again, as these signs of cultural and political dissent in the U.S. As we head towards another election, how much do investors need to pay attention to these issues?
So you need to pay attention to geopolitical and political risk factors. But then you have to make an assessment as to will they fundamentally influence the way the U.S. economy behaves. One of the big advantages of the U.S. economy relative to others is that the private sector is incredibly vibrant and tends to operate well under different governance developments. If we start taking governance into account, then we're going to start worrying about a lot of countries, because the U.S. is not the only one to have a polarized conversation going on. There's many other countries that are having difficulty forming governments, forming stable governments, let alone controlling their narratives.
Mohammed, besides governance, one of the things that Fitch cited in their decision was medium-term fiscal challenges, namely the impact of the aging population on expenditure programs. So, saying over the next decade, higher interest rates and the rising debt stock will increase the interest service burden due to this aging population, rising healthcare costs. CBO projecting that these interest costs will double by 2033 to 3.6% of GDP. So given that kind of argument for it, just, I guess, playing devil's advocate with this question of why now, but does this matter more than down the line?
So many of us have worried about the longer term fiscal outlook and the need critically to promote high, sustainable, inclusive growth. We don't have a debt problem as long as growth continues to pick up. And one of the upside surprises has been not only that actual growth has picked up, but the potential growth is starting to be positively impacted by policy. And that's a really positive development that we haven't seen for a number of years. So yes, we should focus on the longer term debt issue. The solution to that comes from economic growth and the need to revamp economic growth models. Most of the economic growth models in place today in the US, in Europe, in China are less potent and need to be revamped. And that's what I would focus on. And ironically, again, going back to the issue of timing, this comes after better than expected US growth numbers and after people have revised up the outlook for economic growth.
So let's turn to your outlook for economic growth, Mohammed. Are you in agreement here that things are fairly solid at the moment, but not only that, that we could indeed have a soft landing and avoid a recession? What's your current thinking on that?
So, I've been consistent over the last year saying there is no reason for the US to fall into recession. If you look at the US economy on a standalone basis, endogenously, it is vibrant enough, it is flexible enough, and is handling this global soft patch well. Is there a risk? Yes, there is, but it comes from another policy mistake. My greatest worry is that the Fed will over-tighten, that the Fed will continue pursuing an inflation target, 2%, that makes less sense for today's structural and supply side elements. If we were to sit down and try to formulate what is the ideal inflation target for the US economy, I doubt that we would come up with 2%. We'd come up with something closer to 3%. It acknowledges the change in globalization, it acknowledges the state of our labor market, it acknowledges the changes in supply chains, and critically, it acknowledges the energy transition. The problem, as you know, is that it's very difficult for a central bank that has been missing its inflation target to announce a change in its inflation target. So I understand why the Fed doesn't want to talk about this, but the only reason we would fall into recession, absent some massive geopolitical shock, the only reason we would fall into recession is if the Fed is so focused on 2% and wants to deliver it quickly that it over-tightens.
As you say, Mohammed, this has been your concern for quite some time. We've been talking about it for a while. The Fed has been tightening all year. The economy's going okay. So what now does that policy mistake look like exactly? In other words, is another increase a policy mistake at its next meeting? Would it have to be further than that? Give us some sort of details around what that would look like.
So first, as you know, I wouldn't have hiked in July. And I certainly wouldn't hike in September. But then there's a more fundamental issue, which is what I regard as excessive data dependency by the Fed. Yes, you want to look at the data, but you don't want to be driven by backward-looking data when your tool acts with long and variable lags. Okay, so you have to have a strategic view of the economy as to where it's going and where is it likely to settle down on that. So I would critically start moving away from this excessive data dependence, because my biggest fear, Julie, is by the end of the year, headline inflation will start turning up again. And at that point, the Fed, if it continues to be excessively data dependent, will be put in a really hard position. And that's what we don't want that. We want the Fed to take the long view, to target the medium-term inflation and make sure that we don't unnecessarily damage economic growth in response to short-term data.
Mohammed, I want to ask you about the potential impact, longer-term impact, I suppose, to treasuries given the Fitch move. Does this create any kind of destruction of demand to, say, long-term treasuries or short-term treasuries?
Not by itself. You know, Diane, one of the big questions is, what do you replace the U.S. Treasury bonds with? A critical aspect, as you know, in financial markets is they often solve in relative, not absolute space. People have to hold something. And often people are very tempted to say, this is no longer any good. And then you say, well, what is it being replaced by? You cannot replace something with nothing. And so far, there is no single other country that can replace the US in terms of reserve currency and in terms of the most liquid financial system. So I don't think that this Fitch rating changes anything, because if you were to apply the same criteria to other countries, you would probably downgrade them as well. And Fitch is going to have an issue now that it has put governance up front when asked, well, what about these countries that can't form governments? What are you going to do with them?
That was Allianz Chief Economic Advisor, Mohammed El-Erian. The S&P 500 currently trading lower today. We've seen a lot of moves. You can see it's down about 1.25% right there. And a big move by Oppenheimer today, raising its year-end price target for the S&P to 4,900. That's 27% year to date, if we get to that point. We're going to hear from the strategists who made that call. Don't miss our interview with John Stoltfus, Oppenheimer Chief Market Strategist. You can catch that at 3:15 p.m. Eastern Time. That's it for now. I'm Jared Glickery.